Okay, hi everyone. A very good morning to you all. Thank you for joining us for what is our second K3 Hub CPD webinar of 2025. For the regular attendees amongst you, you may well have spotted that I'm not Marie Wadeson, your regular host. Marie's taking a well-earned break today, and I'm stepping in for her for this week. My name's Richard Easterby. I'm a director at Quantuma, which is part of the K3 Capital Group. I'm a licensed insolvency practitioner, and I head up the restructuring offering in the Birmingham Quantuma office. And that means I take the lead on many assignments, both locally and nationally. And those assignments have either a transactional element, a contentious element, or both. The K3 Capital Group offers a wide range of niche advisory services, including restructuring, debt advisory, corporate finance, forensic accounting, R&D tax credits, and also marketing services for professional service firms. So just a bit of background about the K3 Hub. This webinar is part of the K3 Hub training and events program. And in 2021, we launched the K3 Hub, which is a member network for professional advisors, which today has over 3,000 members, many of which are on the webinar today. As we'll be discussing tax planning for OMBs today, I wanted to set the scene for you and briefly touch upon what I'm currently seeing in the market, particularly in the restructuring and insolvency world, before I pass you over to our speaker, Chris Thorpe. So it won't surprise you to hear that it remains a challenging market with a lot of activity, which means that the restructuring and insolvency team are busy. And in relation to owner-managed businesses specifically, we're seeing a lot of difficulties in the B2C environment. And we've had recent engagements in the travel industry, the hospitality industry, and we've also been instructed by a company that deals with kitchen supplies. The leisure and hospitality sector is always a busy one for us, but it will become even more challenging, we believe, due to the increasing labour cost that is due to come in this April with the change in employers' national insurance rates and thresholds, but also the increases in minimum wage and national living wage levels. So that's on the supply side of things. On the demand side, it's also challenging given consumers' squeeze on discretionary spend and the ongoing cost of living issues. And that will continue until the interaction between price and wage inflation corrects itself. But it's also a factor that consumer habits are changing. It's very unlikely that I want to do the same thing that someone who's just leaving university or school might be wanting to do. And also the level of disposable income that those sorts of people might have it can be a real challenge to add to the spend in the hospitality arena. Anyway, on to today's session. I'm delighted to welcome Chris Thorpe as our speaker. So a little bit about Chris. He is a fellow of the Chartered Institute of Taxation and a full member of the Society of Trust and Estate Practitioners, as well as a non-practicing barrister. Amongst other things, he specialises in capital gains tax, inheritance tax and trusts, and also capital allowances. He's currently a technical officer at the Chartered Institute of Taxation and lectures on a freelance basis. So before I hand over to Chris, I just need to run through a few housekeeping points. You'll notice that we are recording today's session, and the recording will be on the K3 Hub and Quantuma websites next week. I see that we've had a couple of requests for that already in the chat. On those websites, you'll also see a list of upcoming events. The Q&A function is open, so do feel free to ask questions as we go along. And our preference is that you do use that Q&A function, but Chris is also happy to take questions in the chat. There's a lot of people on this webinar today, and so we do expect lots of questions. So that does mean that we won't get around to all of them. So if we don't get around to your question, we will ask Chris to respond to you separately via an email after the webinar. It's going to be a long one today. It's scheduled for 3 hours. So we will be taking a couple of comfort breaks throughout of about 10 minutes each. and those are roughly going to be at 10 and 11 o'clock, but Chris will give you some warning on when those might be. So that just leaves me to say thank you for your time today. I hope you enjoy the session. I'm sure you will. If you want to reach out to me about any issues that your clients may be facing or anything that I've discussed already, then I'd be happy to have a chat. My details will be shortly posted in the chat box. There may already have been. So without further ado, have a great weekend. Enjoy the session. And Chris, over to you.
Okay, thanks very much indeed, Richard. Good morning, everyone. Well, I don't think I need to give any more introduction. Richard has very kindly given me one there. So we'll just crack straight on with some of the issues that are going to be affecting OMBs. And if I can get my slides going, I think the first one obviously is going to be Keir Starmer and Rachel Reeves, and the recent budget is obviously going to have an awful lot of implications. I'm sure you're all aware of the main issues here, and your clients certainly will be, but just a bit of an overview. We had an increase in the rates of CGT. Rather oddly, even though it was a simplification in that for most people it's now going to be 24%, whether it be a residential property or not. The odd thing is that we've had a mid-year raise. So that change took effect straight away. So disposals on or after 30th of October are going to be hit by this new rate. Unfortunately, HMRC weren't quite ready for that. And so the 24-25 forms, the tax return, the CGT pages will not reflect that. So you may have to either work it out yourself with the different rates. HMRC do have a calculator that's available as well. Carried interest, if any of your clients are involved in that, that's going to be going up very soon, up to 32%. I believe there is going to be a further change. And ultimately, the plan is to tax this per income, but that has been subject to a recent consultation. But at the moment, we've just had this rate increase. BADR, I'll be talking about BADR, Business Asset Disposal Relief, a little bit later with regarding CGT reliefs. For many years, it's been 10%, and whilst it was entrepreneurs relief for many years, it was 10%. There was some speculation that it might be gotten rid of completely in the budget, but it survived. But the rates are increasing this year and next. So from next year, it'll be up to 18%. There was also a thing called investors relief, which is a very rarely used relief, which is available for business angels. Sorry, the sound quality. I'll try and speak up a bit. I do beg your pardon. It's probably not you, Gary. It's I think there is a possible problem on my end, so I'll try and speak up. Investors relief is generally used for business angels who are not employees or officers in the business. But their rate had always been £10 million, a bit like the old BADR relief before March 2020 had been £10 million. But investors relief had stayed the same. So investors relief has now gone down to the £1 million, just as BADR has. You're probably aware as well, it's featured a lot on the news, the employer's national insurance. Bit of a double whammy, because not only have the rates going to go up in April, but the secondary threshold is going down as well. So I think that's possibly something that's a little bit overlooked. So the amount of salary that employers start paying the tax has gone down as well. One thing to sugar the pill slightly is an increase in the employment allowance. It's gone up from to £10,500. Something else that kicked in pretty much straight away as well is the SDLT, the stamp duty land tax surcharge for additional properties, has gone up to 5% from 4%. Also this April coming as well, the SDLT rates are going up as well, so another double whammy there. I'll come on to agriculture and business property relief in a moment, a little bit later on anyway. But another thing to bear in mind, a little bit on the horizon yet, but inheritance tax will be charged onto unused pension pots from 2027. This personally, I didn't see this one coming at all, but pension trustees are going to have to account for inheritance tax on unused pension pots. I suspect that's going to be subject to further consultation anyway, so just watch out for that one. Previously, putting assets into a pension was generally seen as very good tax planning. It was a completely tax-free environment, and it is as far as income tax and CGT is concerned, but it was always deemed to be outside of one's estate. But from 2027, that will no longer be the case for unused pension pots, so watch out for that one. So moving on to BADR, as I've mentioned that one as well, it was until 2020 known as Entrepreneurs Relief. You might still find some clients calling it Entrepreneurs Relief still. Before that it was Taper Relief. Before that it was Retirement Relief. Often what goes around comes around. But what is it? Essentially, it is the 10% rate on the first £1 million worth of gains. Now, that £1 million, don't forget, is a lifetime limit. So you have, for qualifying gains, and I'll come to the qualification in a minute, you can only use £1 million of them for this relief in a lifetime, not in a year, in a lifetime. Now, if before 2020 it was £10 million. Now, if you had, say, £7 or £8 million worth of gains used already, when it reduced to 1, there was no clawback or anything. It just simply meant you've used it up. So it was a very clever change from the government's perspective. They sort of abolished Entrepreneurs Relief without actually abolishing it. But anyone who'd already made over £1 million can no longer use it because that is a lifetime limit. The point is that this is a relief for the sale of a business, essentially. There are a few variants, but it's for the sale of a business, and it does not apply to what HMRC call mere assets. So if you've got an ongoing business and it's simply selling off a bit of land, it's simply selling off a building, whatever it may be, that is not a BADR issue. What you're talking about is selling the business. So it's a freestanding trading business, or a trading business as a whole, so if they decide to pack up entirely, after 2 years continual ownership. Now, the only time you can get relief for selling off a mere asset is once you have ceased the business. So once the business ceases, you've got a 3-year window in which to sell off the assets. So that's the only time the assets can be sold and this relief claim. So if the assets are being sold and the business is carrying on, you can't have it. Another variant is that you can have an asset that's used personally but owned by a company or partnership. So your personal company or a partnership of which you are a member. Now that is known as an associated disposal. Now we'll have a look at that in a little bit more detail, but essentially you need to withdraw from the business at the same time. So again, you can't carry on business as usual is the theme. You have to sell an element of that company or that partnership at the same time as selling this personally used asset, I beg your pardon. Another restriction with that as well is if you're charging rent. Trusts, if it's an interest in possession trust, a trust can also benefit from BADR as well. The life tenant or the beneficiary has to be running the business essentially, but they are able to claim this. Likewise, if you sell company shares, so forget sole trader or a partnership a minute, if you have company shares, as long as you own more than 5% of the ordinary share capital and voting rights and a few other bits and pieces, and as long as you're an officer or an employee, the sale of those company shares can also qualify for BADR as well. But the key thing is this last bullet point. You need to watch out for trading status. This only applies to trading businesses or businesses that are substantially trading. So just coming on to this mere assets, I found this it's an old bit of guidance actually, but it really sums it up what I was saying about mere assets. It actually dates back to retirement relief days, so it shows you how old it is. But for retirement relief, read BADR, to be due, the whole of those activities must cease when the relevant assets are disposed of. By contrast, if an asset or assets have been sold, but no particular activity or set of activity disappears with that disposal, it cannot be said that any part of the business has been disposed of. Retirement relief, i.e. BADR, will not be due. So you're looking at the actual business activities. They have got to cease. Or for associated disposal, you've got to start withdrawing from that. So selling the asset on its own is not enough, is what that's trying to say. There is just one slight quirk in the guidance. For any of you or whose clients are in farming, HMRC do have a view whereby if you go from one type of farming to another, that constitutes a cessation of trade and you are able to qualify for BADR. They mention this case of Rawlings, where you go from where you take up, say you've got an arable farm, you sell that and you take up dairy, for example, or the other way around, or whatever type of farming it may be. Even though you are still farming, so in the first instance you might think, well, I haven't ceased business, why should I get BADR? HMRC do accept that different types of farming are almost a business in themselves. So it's only in guidance. There is the rulings case to back it up. When I was in practice, I had one client and we managed to claim what was then entrepreneurs relief for this. But just bear in mind, it is guidance, but that is the approach HMRC will take. So if you go from one type of farming to another, but you're still farming, you can actually still get BADR according to the guidance. With the share sale, just a little bit more detail on that. It's got to be an unquoted company as well as trading. It's got to be unquoted, or it can be on the AIM market, the alternative investment market. So it's got to be a personal company, so that means 5% of the ordinary share capital and the voting rights. But from 2018, it also includes as a 5% or more right of the distributable profits and the net assets upon winding up. Alternatively, if you didn't meet that definition, there is like a fail-safe. As long as you have a right to 5% or more of the sales proceeds, if the business were sold, that will suffice. They just wanted to beef up the 5% criteria a little bit more. They felt that ordinary share capital and voting rights wasn't quite enough. So you've got to have a right to distributable profits and net assets upon winding up as well. Just make sure, ideally, all the shares are pari passu, all the shares have the same right to dividends, even though they may be alphabet shares. They're pari passu, that shouldn't be a problem. You've got the 2 years, so it used to be 12 months before 2018 as well, but it's been 2 years now for a little while. That 2 years can include pre-incorporation trading. That applies if you have a Section 162 incorporation relief scenario. So if you incorporate a sole trade, for example, and relief is claimed under Section 162, the 2 years for the shares, you can actually borrow that time that you traded as an unincorporated body as well. Previously, before that, if you incorporated, you had to hold on to the shares for another year, then sell it. But if you've been trading as a sole trader for more than 2 years, have a 162 incorporation, you can now sell the shares the next day and qualify. The other major criterion is that you must be an officer or an employee in the company in the 2 years prior to sale. So when you look at the date of sale for an unbroken 2 years, you must be an employee or officer, so a director, or you can be a company secretary as well. And company secretaries aren't necessary in private companies anymore, but that will still count. It's still an officer. Now, it should be quite a binary. You either meet that criterion or you don't. So you're either an employee on the payroll or you're not, or you're registered as Companies House as an officer or you're not. There have been a few cases, and I've just put a couple of old ones down here, Richard Hurst and Susan Corbett, whereby they were given their P45 before they sold the business. So there was a gap. So in theory, they did not meet this criterion. However, it was held that they were still doing the exact same job as they were before. So they were what were called de facto employees. Now, there's no such thing as a de facto employee. It's de jure. You're either an employee or you're not. But there were first-tier tribunal cases, both of those. The facts were a little bit unusual in both. And it was held that actually they were still doing the same job. Yes, we've got a very good question here from Jan. Yes, you have to be an employee for the prior 2 years. You can't immediately do it after incorporation. You're quite right. I was just talking about this that particular criterion in isolation. You're absolutely right. It was 1 year prior as well. But what I mean is, for the holding criterion, you could in effect let it go the same day. But you're quite right. You've got to be an employee anyway. But no, thank you for pointing that out. So I'm just trying to find my next slide button. The pre-incorporation trading, interestingly, actually, I hadn't noticed that when it was first changed. I've never known it being used for the exact reason that Jan has said, because you've got the employee criterion as well. No. Please don't worry about it, Jan. It's an interesting. It's a perfectly valid point. Just a word with trusts as well. It's got to be a particular type of trust. Like I said, it's got to be an interest in possession trust. So that means the life tenant has a right to use the assets in there. Now, in this scenario, you'd have a trust which either held that life tenant's business assets, so land, buildings, what have you, or it may hold their company shares. Now, if it holds the company shares, then the life tenant must also hold at least 5% or more. They must also be officer employee. They've got to meet the exact same criteria. But it's envisaging a scenario whereby the trust will hold usually a majority of the shares or a good portion of them. But very often, if it's a sole trade or partnership, the trust will be holding a lot of the assets. Well, in that case, once those assets are sold or the shares are sold, the trustees themselves can qualify for BADR by virtue of the life tenant's business. So as well as the company share criteria, as I just mentioned, being in place, if they're company assets, they must have been used for the last 2 years out of the last 3 as well. Now, just on the second bullet point about being a qualifying beneficiary, there's the case that went through the Court of Appeal whereby HMRC argued about this. They said that you had to have been a qualifying beneficiary, i.e. a life tenant, for the full 12 months prior to sale. But the Court of Appeal decided that no, that's not actually the case. The legislation simply says that you must be a qualifying beneficiary at the time of sale. The first tier tribunal said that. The upper tier tribunal disagreed, but then the Court of Appeal upheld the first tier tribunal's decision. So I've got a little bit of, I'll not go through all the detail here, I'm just slightly mindful of time, I've a lot to get through. So the copy of the slides are there so that you can have a read of it. But the one bullet point I will just mention is the very last one on this slide, where the Court of Appeal basically summed up what I'd said. There is no requirement that you should have an interest in possession for any minimal period, but only that the interest should exist at the time of disposal. That was really the nub of the whole case. So you do not need to have an interest in possession in place for the full now 2 years, but 12 months at the time. It is just at the time. Just one thing I want to hammer home again, it's got to be a trade. This is mentioned specifically in the legislation. You're talking about, I mean, a business to claim ER is BADR as well. It's exactly the same wording now. It's a trade, profession or vocation carried out with a view to make a profit whose activities do not to any substantial extent include activities that are not trading. That is slight Sir Humphrey double negative speak to say it's got to be substantially trading. Now, traditionally, we've looked at like an 80-20 split for this, so sort of 80% is deemed to be substantial. So when you look at the income of the business, when you look at the asset values, as long as at least 80% go to trading, you are allowed a little bit of investment element in there without ruining this relief for you. Now, one thing I've just mentioned in here, so when I was in practice, I dealt with a lot of farmers, and this was a very valid issue because, of course, a lot of farmers, in fact, probably every farm in the country, has diversified to some extent. Now, most will diversify into other trades, so contracting, for example, but a lot of them may well be diversifying into investments. So we've got it down there, renewables is obviously a very big thing now, livery, particularly if it's DIY livery, and ASTs, short hold tenancies. And of course, from this year, furnished holiday lets now count essentially as a short hold tenancies. They now count as ordinary rental income. So if you diversify too much, you could very easily trigger that 80-20 rule. However, just that 80-20 rule, it's an unofficial one, and HMRC still use it, but there has been some warning against using such a simplistic term. In the Assam Alam case a couple of years ago, the upper tier tribunal said that you really just need to have a look at this as a whole. You need to take a holistic approach to the business rather than simply use what they call a numeric test. So generally have a look at the trading income and the non-trading income and trading income and non-trading assets and have a look to see whether it's 20% more. So the 80-20 rule is still there unofficially, but they're just saying, well, hang on, go a little bit further, look a little bit deeper. So look at the income, look at the asset values for sure, but do have a look at other aspects of the business as a whole. So time spent by employees, management, company history of diversification. But income and asset values are still the main one. So essentially, if you've got 80% or more of those as trade, you should be all right. But if you do have some investments in there, just make sure that you have a look. Now, associated disposals, I just wanted to touch upon this because this has a few more moving parts, as it were. So generally, we're looking at the sale of a business. So a sole trader sells their business. A partner in a partnership sells their share of the partnership, and that's quite a simple way. We've got the sale of shares as well. Like I say, that's quite a straightforward one on the face of it. Hold the shares for 2 years, officer employee. You've then got this one about associated disposals as well, which is a separate section of the legislation. So these are assets that are owned personally, so they're not on the balance sheet. They have to have been owned personally for at least 3 years prior to sale. They have to be used in a partnership of which an individual is a partner. Incidentally, they can only have a 1% stake, and that'll do. It just says, are they a partner? Because for the BADR legislation, partnership share equals sole trade. So there's no 5% with a partnership. That only applies with the limited company element, the personal company. What you've got to do, and this is the bit that it is a little bit up in the air, is it has to be sold as part of a withdrawal from the business. Now, you don't necessarily have to sell the asset and withdraw at the same time. There can be a little bit of variance in it. As long as it's part of one overall withdrawal, that's generally going to be okay. So you could withdraw from the business. You could, so for example, you could sell your 5% share and then sell the assets 6-12 months later. In fact, I think HMRC's guidance mentions that you've possibly got up to 3 years, because sometimes things can take a bit longer to sell. As long as it's part of one overall plan, the order doesn't necessarily matter too much. Trading asset, does the holding of substantial, that's a very good question we've got there from Caroline. Does the holding of substantial cash in a trading business affect the trading status? The answer is it could do. If that cash is working capital, it should be okay. So if it's in a current account, for example. If, however, it's locked away in an investment account, it's not been touched for a while, there's no sign that it's going to be used in the next, in the next couple of years, then potentially that could be a problem. I remember when I was a trainee, I was at one of my jobs to have a look at balance sheets and see if there's too much cash in there, because that can potentially, that could potentially mean that that cash is an investment asset. So yes, possibly. So generally try to ensure that that cash is working capital only. So have something in the director's notes to say that we're going to be buying these, a new asset in the next couple of years, or putting it aside for growth, or whatever it may be. Just make sure it's got something to do with the business and it isn't just sat there doing nothing. So as part of this withdrawal from the business as well, you have to sell at least 5% of the capital. So either the company shares or sell your stake in the partnership as well. It's been held for at least 3 years. If you have less than 5%, that's okay, but you've got to sell the whole lot. The restrictions, however, are the bit I just wanted to touch upon and just highlight. If you have an element of non-business usage, so you've owned that asset for, say, 10 years, but it's only been used in the business for 8, and it doesn't necessarily matter which way round, it's for the entire period of ownership, then only 8/10 of the gain will qualify for this relief. So any non-business usage is going to be carved up, and that's going to be chargeable. The other thing as well, as I alluded to in my introduction, is if you are charging your company or your partnership rent. If you're charging a full market value rent, you will not get BADR at all from 2008, because it's an investment asset. You're charging rent for it. It's done on a sliding scale. If you're not charging any rent at all, or a peppercorn rent, you'll get the full relief. But if you're charging, say, half rent, then you get half relief, essentially. I think that can cause a bit of a practical head scratch. How do you value what the rental value is? But generally, you're either charging a market rent or you're not charging anything at all. And it can be occupied under a farm business tenancy, for example, or just under license or an ordinary lease. That doesn't matter so much. It's the rent that's being charged does matter. We've got a provision in there as well that says no share or partnership purchase arrangement. What that essentially means is that you can't do any sort of artificial planning whereby you sell the business and then buy it back a little bit later. There was some uncertainty as to what that meant, but I've never come across that being an issue, but I think it's a fairly innocuous anti-avoidance provision. So just a couple of issues. First off, not necessarily to do with tax, but is the asset personally owned or not? For a limited company, hopefully it should be a little more clear-cut. But with a partnership, where the legal ownership of the asset is in, person A's name, well, is that theirs, or are they holding it for the partnership? So sometimes you've got to be a little bit clear as to whether it's a partnership asset or not. The partnership agreement should really state what assets are in there. Generally, if something's a partnership asset, it's been bought by the partnership or has been introduced as partnership stock. So now, if it's On the balance sheet, and it's a partnership asset, you don't need to worry about associated disposal at all. That doesn't come into play. It's part of the business. You sell the business, you get the relief. If, however, it's personally owned, that's what makes this an associated disposal. Straight off as well, inheritance tax. We'll be having a deeper look at this, but if it's an off-balance sheet asset, you will only ever get 50% business property relief. So forget the budget changes, the 2026 changes coming in. The 50% bands aren't changing at all. If it's an off-balance sheet asset, the most you will ever get is 50%. So you're not even going to get a shot at that £1 million 100% allowance. Say, is rent being charged? Like I've already mentioned, for associated disposal, if full market rent's being charged, that's going to be an issue. Whether it's under farm business tenancy or license doesn't actually matter for these tax purposes. It's the rent that matters. But there may be a legal issue in there as well. The lawyer might have something to say about the occupation. And the SIP, say until 2027, SIPs, pensions, can hold assets. So you can hold, the trustees of the pension can hold an asset and you can charge all the rent you like. And it's income tax free. It can grow in value and there's no CGT or BADR to worry about at all. And I would have said that inheritance tax isn't going to be an issue either with a 50% BPR, but so from 2027, pensions are going to be subject to tax. So that is going to be an issue. But as far as the income tax and the CGT for this BADR is concerned, pensions and SIPs are still a potentially viable option. So let's have a quick look at trading vehicles. I've mentioned partnerships and associated disposals. Let's just have a look at the types of partnership and what makes a partnership asset. So what we're talking about, when people say partnership, they generally mean a general partnership. That's not a word in legislation, it's called partnership. But it's defined in the Partnership Act 1890 as two or more people carrying on business in common with a view to make a profit. That's the opening definition of a partnership. There's very little in the way of formalities or regulation about this. It's simply, basically, as far as tax is concerned, it's multiple sole traders coming together. But the issues, we've got unlimited liability for one thing. So just like a sole trade, you're fully exposed to any business risks. The partnership is transparent. It's essentially a bare trust because the beneficiaries, i.e. the partners, are taxed on their share of the profits and on the capital gains. The partnership itself does not pay any tax, even though you're reporting it all on a partnership return. Now in Scotland, it's a little bit different. Partnerships are regarded as being firms. They are a separate entity to a degree. But there's also in partnership law as well, so not tax, but within partnership law there's a thing joint and several liability. So if one partner does something wrong, it can affect all the others as well. And so that means sometimes you've got to be a little bit careful about who a partner is. Because if a partner or someone who holds himself out as a partner does something wrong, gets sued, for example, the other partners are going to be in trouble as well. Now, a limited liability partnership, an LLP, is a very common one amongst accountants, lawyers, and other professionals. Fairly new. It only came into... Oh, can't hear me at all. Sorry, I'm doing... I hope everyone else can. I'm on full volume and I'm speaking as loud as I can. Yeah, a limited liability partnership came around in 2001, so it's quite new. And this is a bit of a hybrid. For tax purposes, it's exactly the same as a general partnership. So no difference at all as far as tax is concerned. Same tax return, the works. The differences are all legal. So you do have limited liability. You do have limited liability. So basically your neck's only on the line for whatever you've invested. It is a separate entity for legal purposes. So it can hold property, it can sue and be sued. But that's assuming it's trading and it is solvent. Also, and something that's usually very popular, there's no joint or several liability. You're only basically, like I say, you're only on the line for what you've invested in the business. But there are company's house formalities. Because it's a body corporate, just like a limited company, you've got to submit the returns, you've got to submit the accounts to company's house, just like with a limited company. So for tax purposes, this is exactly the same. You might come across a thing as well called a limited partnership. These things came out in 1907. I've never seen one in practice. They tend to be used now with dodgy tax avoidance schemes. They basically give sleeping partners of a general partnership limited liability. So it was mainly to attract investors. But so the ones that you're going to see really are these two. and as far as tax is concerned, they are exactly the same. So a partnership is transparent. A partner is taxed on their share of the trading profits and the CGT. They pay NIC on it as well. The partnership itself does not pay tax. The partnership just reports it. And then on a partnership return, it says what the various partners' profit shares are. It is obviously a separate entity for pay-as-you-earn, because it can have employees of a partnership. So for pay-as-you-earn, it will have a separate entity, and also for VAT purposes. The individual partners are not registered for VAT. It is the partnership that is registered. So it is a separate entity for those people as well. Something that's very important to have, I mean, it's not a legal requirement, but it's certainly highly advisable, is to get a partnership agreement in place so the partners can determine what happens to everything, really, within the business, right the way from who gets what happens if someone gets ill, what happens if someone dies, what happens to the profit share, everything. The constitution of the partnership should be included. If it doesn't, the Partnership Act 1890 determines what happened, and it can be quite strict. For example, it says that it's equal profit and capital shares. Now, you might want that, but most partnership agreements will want to vary that from time to time, or they'll want different fixed amounts. The 1890 Act says that you cannot have interest on capital, for example. Well, you may want that. It also says equal management participation. Now, in a family business, there might be the younger generation involved. You might not want them to have any management participation at the moment, maybe just mum and dad to have it, so you need to specify. And crucially as well, the 1890 Act says that if a single partner dies, the partnership gets wound up, no matter how profitable it is, no matter how well it's doing. So you obviously don't want that to happen. So you have provisions in the partnership agreement to say what does happen when a partner dies. And it should say something along the lines of, when a partner dies, the other partners will have an option to purchase. They won't have a right to that partnership, because that can affect your APR and BPR. Because APR and BPR for inheritance tax says that there must not be a binding contract for sale. So nothing must be a done deal. So generally it says there is an option to purchase to give them first dibs. The presumption as well is that all partners have an equal share of the partnership assets, like I've said, with capital shares. And this is what you have a capital account for in the accounts. I know some firms just have a current account which has capital in there and your drawings and your profit share. That's fine. When I was in practice, it was good to have separate capital accounts. And even then, within farming, you'd separate the capital accounts out to land accounts and plant and machinery, what have you. Because the capital account shows what has been put into the partnership, what you have put in, and it can show what you can take out as well. The current account shows profits going in, drawings coming out, just like with the sole trader. Now, partner as well, when you say partner, that generally means equity partner, and that is generally going to be self-employed. Now, with LLPs, don't forget, there is the disguised salary rules, conditions A, B, and C, so that can potentially temper that. But when you're looking at a general partnership, if you say someone's a partner, that means they are an equity partner. If somebody is a salaried partner, well, obviously that's an employee as well. But the thing you need to watch out for, like I said, is anyone who knowingly holds himself out as a partner can be liable. So you've got to just watch out who is actually a partner and what they're labelled. So you might want a junior partner, for example, to be called an associate partner. So it's made clear that actually they're not full equity partners in that case. They're essentially salaried partners. Just a word for inheritance tax as well. Just like with income tax and CGT, the partnership is transparent for IHT purposes. So you have a stake in the partnership. There's a subtle difference with a general partnership and an LLP. With a general partnership, you have rights over the underlying assets. So you have shows in actions. So you have a right to certain proportions of the assets, ideally laid out in the partnership agreement. With the LLP, it's actually an interest in the assets themselves. It's not a right over them, it's the assets themselves. It's a subtle difference. I'm not 100% sure of the justification for that, but there must be a reason. Corporate members as well. I wasn't sure where to mention this within the talk today, but I thought, of course, a partnership can have a limited company as a partner. Why might you do that? Well, often it's good for diversification. Again, thinking back to my farms, you might have a farming partnership, but there might be a contracting business, and that could be in the limited company. There might be some investments in there as well. There might be some renewables or something like that, or a livery business or something along those lines. In that case, you might not want that in the partnership because it will cease to be a trading partnership, and that'll have a knock-on effect to your CGT release. It may be a way potentially to get the younger members of the family in. You could make them directors of the company, give them some shares in the company. So as well as diversification, it can potentially give a little bit of flexibility as well. One thing you've got to bear in mind, however, is that this mixed partnership, as it's known, does not qualify for the annual investment allowance for capital allowance purposes. Now, one possible easy way around that is just put all the plant and machinery in the limited company and get the limited company to claim the capital allowances. Indeed, another reason for putting a limited company in there is that it can provide plant and machinery labour to the partnership, either in return for a profit share or in return for a management charge. But just watch out for that rule. If you do have what's called a mixed partnership, the partnership itself cannot get the AIA. So a partnership asset, what is it? Like I mentioned before, it's an asset that's bought or acquired by the partnership. So hopefully that should be relatively straightforward to identify. The partnership should have a separate bank account, and if that bank account has been used to purchase an asset, well, that's going to be a partnership asset on the face of it. Or it's been introduced by one of the partners as partnership stock. Now hopefully for that, you should have a paper trail for CGT purposes. There should be a disposal of some of the beneficial interest in those assets. Yeah, sorry, getting various messages about sound. Some people can hear me, some can't. I'm on full volume and I'm speaking up, so I promise I'm doing everything my end that's okay. So yes, if it's introduced as partnership stock, you are disposing of part of your asset to the other partners, or as whatever the partnership agreement says, in which case you should have a CGT return. There should be a holdover claim as well, because if it's a trading partnership, you should be able to claim Section 165 holdover. So there shouldn't be any tax to pay, but hopefully there should be a paper trail showing that. Now, like I said, the intention is if you put an asset into the partnership, the presumption under the 1890 Act is that it's going to belong to all the other partners as well. So you may not want that. So if you're mum or dad, for example, and you only want the two of you or maybe one of the other partners to have it, you need to specify where the beneficial ownership of those assets are going. So to 2 or 3 of the partners, not all of them. But the presumption is that it's going to go to all of them. But usually there's going to be a part disposal of the asset to at least some of the other partners. So that's where the CGT will be triggered, but hopefully the holdover will mean there's no actual tax to pay. If an asset is on the balance sheet, that does not automatically mean it's a partnership asset. It can be good evidence. You know, you've put it on the partner, you've put it on the accounts for a reason. However, if there's ever any doubt, the law or equity, more precisely, will go a little bit deeper. And they'll say, what was the intention behind that? Was the intention to actually make it a partnership asset or not? If the intention actually is that it was a personal asset but used by the partnership, well then it's not a partnership asset. So sometimes this often can go to contentious probate. This is why, again, it's very important to make clear in the partnership agreement what is a partnership asset or not. Even have an inventory of saying the assets, who they belong to, or whether they are a partnership asset or not. Now, don't forget the owners. You can have up to 4 owners. When we're talking about land anyway, you can have 4 owners of property in England and Wales, but you can have multiple partners. Again, that's why essentially a partnership is a bare trust. So if you've got an asset that's sorry, I'm just keeping an eye on the chat as well. If you've got an asset that's owned personally but used by the partnership, again, some of the issues I've touched upon with BADR as well. So just sort of going backwards from those bullet points there, BADR that's an associated disposal if it's personally owned, so watch out for rents as well, and also only 50% BPR for IHT. But a couple of practical issues as well. If it's off the balance sheet, then it should be off the balance sheet. It shouldn't be on there, and there should not be a capital account either. But like I say, generally it's going to be occupied or used by the partnership, hopefully under some agreement, a licensing agreement. It can be a full lease. It doesn't matter quite so much. It's about the rent, really. Just watch out as well if you've got a situation where the asset is owned by one or more partners, but they are holding it on trust. It's personally, it's an asset that they have the title to. It's a partnership asset maybe, but if the partnership agreement says that, yeah, this is mum and dad's asset, but they're holding it on trust for the partnership, technically that's a trust registration service issue, because it's using those words, they are holding it on trust. So sometimes you just got to get the wording correct as well. So when you've got different legal owners and different beneficial owners, you could potentially be wandering into trust registration issues if it does mention anything about a trust. What is possible, and there's sometimes a little bit of a fine line, is where one partner, say, has full beneficial ownership, they put it on the balance sheet, they make it clear it's a partnership asset, but only they have beneficial ownership. That's okay. It can still be a partnership asset with all the beneficial ownership ring-fenced to just one person or maybe two. That's fine, but again, you've got to say so in the partnership agreement. And sometimes that might cause a little bit of confusion as to whether, well, is it a partnership asset or not if you still hold it. So again, make it clear in the partnership agreement as to what it is. Because the partnership rules are determined not by legislation at all. It's by a statement of practice D12. I've already mentioned, say, if an asset does go in as partnership stock, there is a CGT issue there. If the beneficial ownership is going out to others, whether it be to one partner or all of them, there's going to be a CGT issue there. So say, hopefully you can get holdover relief in that. Say section 165. Just watch out for the stamp duty, SDLT. I'm not going to go into this in any detail. This is a wholly different area, and generally one where you would generally you get specialist advice on. But essentially, if you are incorporating, for example, you have a look at anything to do with partnerships. In fact, is you need to look at Schedule 15 of the 2003 Act. So if you're putting something into a partnership, or something is going from a partnership into a limited company, for example, if all the partners are related, generally the SDLT is going to be nil because some have lower proportions. However, you've got to watch out if something goes into a partnership and then money is withdrawn from a partnership in the next 3 years, and that can include a change in profit share, then the SDLT can be clawed back. So it is a real minefield, SDLT. So I would strongly advise anything to do with SDLT and partnerships, get specialist advice. But it's all contained within Schedule 15 of the 2003 Finance Act. Now, I won't go into limited companies in too much detail. You should all be aware of most of these points, but it was just sort of in light of the partnership slides, really. As you know, a limited company is a separate legal entity. Not only that, as well, sort of unlike with an LLP, the profits are owned by the company and corporation tax is paid by the company. And as you know, and as we'll look at in a moment, if you want to take those profits out, there are tax implications there. Whereas with a partnership or an LLP, the withdrawals, the drawings are irrelevant. You're taxed on whatever your profit share is. But that's obviously not the same with a limited company as well. So hopefully you shouldn't have this issue about is it a company asset or not, because you've got CGT when assets go into a company, and you've got SDLT as well. Don't forget, it goes in at market value if it's a connected company. It should be a little bit clearer. Often companies are very useful for succession planning because carving up land can be quite difficult. But if you've got a company with 100, 1,000 shares, however many it may be, some of those can be gifted, some of those shares can be retained, some of those shares can be put into trust. The shareholder can also be a director, so they can take out salaries, they can do pension planning. There is quite a bit of flexibility around limited companies. Another one being alphabet shares as well, even amongst shareholders. You know, if all the shares are pari passu and there's one class of shares, generally they all have to be paid the same. But if you have A, B, C, D, E shares, then A, B, C, D, and E can all be paid different amounts. Just watch out with the settlements legislation if a husband and wife or spouses, civil partners, are getting different amounts. The settlements legislation can potentially kick in. HMRC haven't really looked at that since the Arctic Systems case over 20 years ago, but it is still potentially possible. But like I said, with corporate partnerships, limited companies are very useful for diversification as well, because they can hold different businesses. They can be part of a partnership or work alongside a partnership to aid in diversification as well. And as I'm sure you're aware, depending what type of business you're in, and if you want to make a research and development claim, that can only be made by a limited company. I did come across one, it was a farming partnership, again, who'd developed some sort of cattle grid system. And they wanted to claim R&D on it, and they did. But what they did is they set up a separate limited company, which was a partner, and the patent essentially was in that company, and they got it that way. So don't forget, if you're going to make R&D claims, that can only be in a limited company as well. So just have a quick look at extraction of profits, and then we'll probably stop for our first break. Hopefully extraction of profits isn't as painful as that picture, but when we're talking about extraction of profits, we are of course talking about a limited company. If you are a sole trade or a partnership or a LLP, the extraction is irrelevant. You are taxed on whatever your profit share is. If you choose to take all of that out, well, you might as well, you've been taxed on it, but you might need to leave some behind for cash flow purposes. Doesn't matter, you're still taxed on your profit share. But after a company has paid its corporation tax, or before it's paid its corporation tax, whatever you take out of a company, there's going to be personal tax implications as well. So remuneration, salary, if you're a director or employer, or director and employee, as well as shareholder, you can declare yourself a pay-as-you-earn salary and potentially benefit in kind as well. You can pay yourself pension contributions. But the biggest one, of course, is generally going to be dividends, because dividends attract a lower rate of income tax, and also they do not attract national insurance. So generally, it's a little bit of a salary and then mostly dividends afterwards. You can, of course, sell assets to a company. So you can get a bit of CGT there. You can get some proceeds that can be paid over time. You pay CGT on that, and then you get your payments over time. Likewise, you can get a loan from the company. And there are Section 455 issues there, but the company can give you a loan, so they may have to pay a 455 charge. Alternatively, you could loan money to your company and have a director's loan account in place, and you can charge interest, potentially quite a high rate of interest, depending on how old the company is and what the market rate can be. The company's got to fill out CT61 forms, it's got tax at source and the like, so the administrative hassle may not make it worthwhile, but if it's a sizable sum, then it may well be. You can get some NIC free income out of your company that way. If associated disposal, again, if you own an asset personally, if you own a bit of land personally, and the company is using it, you can charge rent. Like I've said many times now, that will affect a BADR claim for associated disposal, but that aside, it's still a good source of NIC free income. You can potentially sell shares back to a company as well. This generally has to be for the benefit of the trade in order for it to qualify for CGT treatment, but nonetheless, it is a way whereby you can get funds out of a company. And the absolute nuclear option, if you're definitely never going to be using the company again, is to liquidate it. And you heard from Richard earlier, a insolvency practitioner early on. You can liquidate the company, and if it's a formal liquidation, you'll only have to pay CGT on your proceeds, not income tax. So just a couple of points. Say a loan from the company. Well, first off, if you're an employee or a director, the loan's above £10,000, benefit in kind charge. So you need to have a look at the official rate of interest. Currently only 2.25%, despite the Bank of England rate being higher. The official rate of interest until April is 2.25%. So if you're being charged any interest less than that, and it's more than £10,000, there's going to be a benefit in kind charge as well. Also, if the loan is written off, and it's been written off as an employee or director, HMRC are going to want some Class 1 national insurance as well. Like I say, if the loan's going to go the other way into a company, get yourself take advantage of the personal savings allowance, potentially charge a higher rate of interest. I mean, I've put 10-15% there. I mean, it could possibly be even more. Now, as long as it's a market rate. If it's too much, of course, HMRC could argue that it's not interest, it's dividends in excess of that. But there's no national insurance on that interest. If you're getting rent from the premises, again, I've already mentioned, just watch out. It will affect a BADR claim. If it's off the balance sheet, you're only getting 50% BPR anyway. So could it go into a SIP? Could it go into a pension? Say, aside from the inheritance tax issues, the SIP could still be a good option for income tax purposes, because then you can charge all the rent you want and it won't be taxed. Just a couple of bits there as well about selling the shares back to the company. It's got to be for the benefit of the trade as well. And liquidation, just watch out, there's a targeted anti-avoidance rule that came out in 2016, whereby if you liquidate a company, but then within 2 years commence the same or similar trade, the capital treatment can be withdrawn. Essentially, it'll be treated as income. So just watch out for that. Bonus versus dividends. Do you want to pay an extra bonus or pay the dividend? Well, like I say, often you've got to do a little bit of a balancing act as well. There's no national insurance with the dividend, whereas there is with the bonus, potentially with employer NIC being lowered. But at least with the salary, you do get a corporation tax write-off for the company, whereas you don't with the dividend. But generally, dividends are still the favoured option because of the lower income tax rate and no NIC there as well. Either way, whether it's a cash dividend or in specie, so some other asset going across, of course, under company law, you've got to make sure there are distributable reserves as well. So you've got to keep an eye on that before any dividends. If you do not have distributable reserves and you make a dividend, it is illegal. It's a company law issue, not so much tax, but generally a thing called a constructive trust is imposed. So the shareholder will hold that money on trust for the company. They can't go and do with it what they want. But the big issue with dividends, of course, is you've got to watch out for the cash flow. So, you can't necessarily take every penny out. So this is something you've got to keep an eye on with the reserves, as I'm sure you're all aware. So maybe take out loans, make a dividend repayment next year, possibly. If you pay back the loan within 9 months of the accounts year end, there shouldn't be a 455 charge. And if the loan is repaid with a dividend, you don't have to worry about the bed and breakfasting rules either. So that might be a better option. The only thing I really wanted to say about hang on, I'm going to all my bullet points here. It's really the third bullet point down. The payment must be wholly and exclusively if you're paying a bonus. So this is particularly relevant when you're looking at family businesses. So let's say your son or daughter work in the business, you want to give them a bonus. You can't go giving them sort of 50, 60 grand bonuses for them working 10 hours a week or something. It's got to be commensurate with their actual duties. If it's too much, then it will be, essentially it will be disallowed. You can't have it. It'll be disallowed as a write-off. But as long as it's paid within 9 months of the year end, it is going to be deductible as well. Pension contributions, again, they've got to be generally proportionate as well. Also, you've got to keep an eye for the individual on the annual allowance of £60,000 gross, because that £60,000 not only includes their own personal contributions, but employer contributions as well. So there is a limit. You can't necessarily go stacking up the pension. So forget the IHT again for a minute. In 2027, there is an income tax issue as well if you go over the £60,000. You are allowed to use the last 3 years' worth of allowances if you're under £60,000. So there is potentially some scope for paying more, but you need to have a look back over the past 3 years and see how much wriggle room you've got with that. And of course, not long ago it was only £50,000 as well. I believe HMRC have got a calculator to work this out. Often I find HMRC calculators a bit hit and miss, but that one is pretty good actually. So if you're a little bit unsure what allowance you've got and you want to take the last 3 years into account, it might be worth having a look at that calculator. Pension contributions, however, have to be in cash. There was a case called the SIP choice case a few years ago now, where they tried to put shares into the SIP, but the upper tier tribunal said no, it's got to be cash. It can't be in specie. Another alternative maybe to paying a bonus, maybe a tax-free benefit in kind instead. A mobile phone, a parking space, extra holiday, something like that. So don't forget the benefit in kind. And with the rent as well, just a couple of points. I've already mentioned the last two, affecting BADR and maximum 50% BPR. But just the first three, again, do not charge an overly excessive rent. If it is excessive rent that's being paid out, then it will reflect the corporation tax deduction. It's a good way of getting some national insurance free income out of the company for sure. But if you own the company, if it's a closed company, you cannot use that £1,000 property allowance that we've got. That only applies for companies which are effectively not your own company. So watch out for charging rent with the BADR, but just again, make sure it's not excessive. just mentioned a bit there about pension contributions, but I'm going to stop there now just for our first break. If we could reconvene at 10 past, please, that would be super. Thanks very much. Okay, it's 10 past according to my watch, everyone, so I'll crack on. So we're now still looking at companies, we're looking at profit extraction, we're looking at loans to participators, because I've mentioned you can have a loan from a company and you can loan to a company and claim a bit of interest. But if a company makes a loan to an individual, we do have a bit of an issue. And I've got one with my slide thing here. Come on, here we go. And this is a section 455 charge. I've even heard a couple of people still call it a 419 charge. I mean, that goes back to the old ICTA 1988, but it's been section 455 for a while now. But this is essentially a deposit that the company has to pay. Come on, slide. There. It's a deposit of 33.75% that is going to be paid. Now, so the first bullet point here, just remember there is potentially for the individual an income tax charge as well, benefit in kind. But if you just focus on the company for a moment, the company has to pay this 455 deposit, and it goes in the corporation tax return as well. If the loan is not paid back after 9 months and a day after the end of the accounting period, so ideally you pay the loan back quickly before then, in which case the 455 will not arise. So it's only if the loan is still outstanding after 9 months and a day after the end of the accounting period you pay this 455 charge. So the advice, say generally, if you need a loan, that's fine, but pay it back quickly. You also get the 455 back when the loan is repaid. So let's assume the 455 has been paid and the loan carries on for many years. Once it's repaid or written off, the company will get the 455 charge back. So it really is like a deposit, a refundable deposit. Oh, still having some sound problems. I promise you my sound's on full volume and I'm practically bellowing at the microphone. So I promise everyone I am doing my best. If the loan is written off, as far as shareholders are concerned, that is going to be a distribution. So it will be taxed on them as a dividend. You know, they're not going to, the company will get the 455 back, but HMRC aren't going to let an individual get away with that. It will be treated as a distribution first and foremost. However, what if, as well as being a shareholder, you are also a director stroke employee? Well, HMRC might think that that write-off, instead of being a distribution, is actually a salary. They'll say that that write-off is in your capacity as a director, in which case not only will they want a higher rate of income tax, but they're going to want some NIC as well. So generally, you're going to have to prove that the write-off was in your issue as issue. I'm looking at the chat box for the word issue. If it is being written off and you are a shareholder and a director employee, try and make sure that the write-off is in your capacity as a shareholder. So generally they'll say, well, have other shareholders have theirs written off or not? So really the point is getting it written down. On what basis is that write-off being made? Don't just assume that it's going to be written off and it's taxed as a distribution. Yes, it's taxed as a distribution first and foremost, but if you are also a director or employee, HMRC will go after that, unless they can see good evidence as to why not. And from their perspective, why shouldn't they? They get the higher tax and they get the NIC. Now, loan to partnerships 455 has actually been extended as well. So if a partner or member of an LLP receives a loan, then if they are a participator in the close company as well, so you've got essentially you've got a company partnership structure. So the company is a partner, essentially. You could argue that, oh, hang on, the loan is coming from the partnership rather than the company, so get around the 455. No, back in 2013, HMRC saw that already. If you're a participator in the close company and a partner as well, you're going to get caught by it as well. So that will not get round it by just simply putting the company in the partnership. Loans to trustees who are participators as well. So if you've got, for example, a trust which owns a partnership share, quite rare, but I have seen it. So you cannot put the company into another structure and have the loan going through a partnership, essentially, is what that's saying. What if you've got two loans. You've made a loan to the company and you've taken one out. Can you net them off, hopefully to bring them down to zero or even bring them into your favour? Well, generally not. HMRC will look at each loan in isolation. There is some guidance about this as well. Generally, the only reason they will aggregate two accounts is if it's held by couples or closely related individuals. They'll mix them together. But aggregating accounts, if you have a look through the guidance, that's not their first policy. So just because you've got a nice big director's loan account, you think, well, hang on, I don't have to pay a dividend, I don't have to pay the 455. Well, you do, because the credit loan that you've got in your DL8 will not offset it. Pay it back if needs be. It's going to be far easier. And then we've got the bed and breakfasting rule as well. This was also brought in 2013 as an anti-avoidance rule. This is where you have a loan with the company, you pay it back, so you get a refund of your 455, and then you immediately take out another loan. So it's just a way of basically keeping that loan, pay it back, get your 455, and then take it out again. Well, to prevent that, if you have a loan of more than £5,000 is repaid, and then within 30 days you take out a further £5,000 or more, you will not get that 455 refund at all. So it's basically matched. They'll say, hang on, no, we're not going to, because you've just taken it out again. Why should we repay 455 when you're just about to take it out again? Even if it's outside the 30 days, if there's any arrangement in place for a loan up to £15,000 and beyond, then this rule will kick in. Now, I've never actually seen this been enacted because there is a very, very easy way around that. And that is quite simply, when you are paying off the loan and getting your 455 back, pay it off with some taxed income. So a salary or a dividend. A very common way of doing this was simply declare a dividend and stick it in the director's loan account to pay off your loan. The dividend will still be taxable, it'll still go on your tax return, but it's paying off the loan, and then you get your 455 back, and then you can take out another loan afterwards. These rules do not apply if the loan repayment is made through taxed income. So just moving away from companies now and having a look at inter vivos gifts. This is a posh way of basically saying lifetime gifts. This is something that a lot of your clients may well be considering in light of the inheritance tax changes coming out in 2026. They think, well, I've got more than £1 million worth of business or farm. I don't want to get clobbered. Even with a 50% relief above that, I'm still going to get clobbered. So let's start gifting it now. Well, let's have a look at some of the issues there. Well, the first one, is it actually a gift? Now, for inheritance tax purposes, it has got to be a gift. So if it's a loan, if it's a sale, if it's an investment, if you're getting anything in return, there's not going to be an IHT issue. You haven't actually given anything away. Because inheritance tax doesn't look at what's going from one person to another. It looks at by how much has your estate reduced in value. So if you're getting rid of a business worth £1 million, but you're getting £1 million in cash, well, you've just sold it. That's a CGT issue. But for IHT, it's still got that £1 million in your estate. So you've actually got to give something away. If you're going to give £1 million business and you ask for 200,000, say, just to cover your costs, well, at least you've still made a gift of 800,000. Still a CGT issue there, though. The second bullet point here, there are certain presumptions that are being made in law, which I'll come on to on the next slide. But there's certain presumptions whereby if a husband makes a gift to a wife or children, it's very outdated and very un-PC, but it's called a presumption of advancement. They are due, anything that goes from husband to wife or kids is assumed to be a gift. Whereas if you are basically, the recipient is simply holding the legal title of the asset rather than the beneficial title, that's what's called a resulting trust. That can very often happen with property and bank accounts as well. Often if you've got an asset that's bought in one person's name, but two people actually contributed the assets, that's another type of resulting trust. So if A bought a property, but bought it in A and B's name, well, A and B will hold it. A is holding it on trust for A and B. So you can have gifts. It's all about the beneficial ownership of these assets. Now, if you make a gift of land, that is presumed to be a gift. Straight off the bat, Law of Property Act 1925 basically says it's not a resulting trust. So that means if the legal ownership goes across, the beneficial ownership goes across as well. However, if it's any other type of asset, the presumption is that only the legal asset goes across. The beneficial ownership stays with the original owner, a resulting trust. What you do, therefore, because that's only a presumption, you put something in writing to say, I am making a gift of this cash, these shares, these whatever it may be. And then the beneficial ownership can go across as well. So generally, any solicitor worth their salt will say that, look, if you're going to make a gift of anything other than land, put in writing that I am making a gift out of natural love and affection for the kids, whatever you want to say, a deed of gift even. Just have something to make it quite clear it's a gift, not a loan, not a sale, nothing else. It has got to be a gift. So, assuming it is a gift, for IHT purposes, we've got 7 years. Once you've made a gift to an individual, it's known as a potentially exempt transfer. And so what that means is it is completely exempt for as long as you stay alive for another 7 years. So generally, if somebody's health is such that you think you're going to survive another 7 years, make the gift sooner rather than later. Now, any of us could be hit by a bus tomorrow, so there's a little bit of guesswork in there, but generally, the sooner the better to get more 7 years worth of cycles. There's actually an error in that second bullet point. I do apologise, I completely overlooked that. The nil rate band of 325,000 was due to be frozen until 2028. It's now 2030, I believe. But suffice to say, the value of assets are going up, the value of property is going up, but the nil rate band has been frozen at 325,000 since 2009. So we've got massive fiscal drag here. So the more growth that we have in the assets, the more the value is going over the nil rate band. So this is why inheritance tax is becoming more and more of an issue, because of fiscal drag and house prices in particular. So generally, when you're looking at gifting an asset, it's very often best to work backwards and think, what don't I need? A proper chartered financial planner, IFA, whatever, should think to yourself, hang on, as you get older, you are going to need a certain amount of income to live. You might need care home fees, you might need repair costs to your house. There's all sorts of variables. So you need to work backwards and think, what do I need? And then what is surplus? You can then gift away surplus assets from there. Maybe you don't need the income from them. Maybe you just don't need the assets in any respect as well. If it's a growth asset as well, now with a frozen nil rate band, it's going to go over your nil rate band. Maybe get rid of it now. A classic example might be land which does not have planning permission. But if it did have planning permission, then its value will considerably increase. So maybe gift it now whilst it's of low value, and let the growth be in somebody else's estate rather than yours. Now, cash generally doesn't have any growth. I mean, interest rates are pretty low, despite Bank of England rates going up as well. However, cash, there's no capital gains tax to worry about, because the flip side of this is the capital gains tax as well when you're making a gift. Might be an option to put cash into a trust, because a trust has a nil rate band of 325,000 as well. And if it's not going to grow, you don't have to worry about that too much. So, forgotten I put this animation. It's like blockbusters. So, potentially exempt transfer or PET. This is where you make a gift to an individual. 99 times out of 100, it's where you make a gift to an individual. So you survive 7 years, it's out of your estate. It can also apply to a trust to a disabled person, often known as a vulnerable persons trust, a very specific type of trust that's geared to an individual with a severe mental health problem or severe physical handicap. An IPD trust is an immediate post-death interest trust. This is an interest in possession trust that's set up as part of someone's will. So not set up in life. If it's an interest in possession trust set up in life, it's a relevant property trust. It's 10-year charges, exit charges, the works. If, however, it's an interest in possession trust set up in life, there's no 10-year charges, there's no exit charges. The beneficiary will be deemed to own it. In other words, it's transparent. So it would be a PET if you put something into that type of trust. You've got the 7 years, may even go up to 10. There were rumours that Chancellor may increase that to 10. But if you survive after 3 years, the potential tax will actually start to taper away. Not the value of the gift, but the value of the tax will start to taper away between 3 and 7 years. So that's another reason to go sooner rather than later. Once you've survived 3 years, it's going to be an option. What a lot of people are looking at doing now is taking out an insurance policy to potentially, if they do die suddenly and it becomes a failed PET, the life insurance policy can pay out. You may have one as well just for your death estate generally. Now, when a gift fails, the primary liability is actually the transferee. It's the individual who gets the asset is actually going to pay this. Now, you can potentially make the gift and make it clear that it's free of tax, so the estate can pay it, but the default position is that the transferee is going to pay the tax. But that's all the inheritance tax. So the other tax we've got to keep an eye on is the CGT. And this is where holdover relief comes in, because if you dispose of an asset and that includes a gift, if it is a gift, it's used market value proceeds, even though you get nothing back. So this is what's known as a dry tax charge. You've got to pay CGT even though you haven't been given any money to pay it with, because it's a gift. And a gift by definition means you get nothing back. So that's what holdover relief is for. Now, Section 165 holdover relief is generally going to be available when you make a gift to an individual, because Section 260 holdover relief, that I'll come on to in a minute, is only available when there is an immediate inheritance tax charge. If you make a gift to an individual, there is no inheritance tax charge, not immediately anyway. So you've got to rely on Section 165. It's a joint claim. The recipient has got to be UK resident, and they've got to remain UK resident for the next 6 years. And the reason why is because the gain is deducted from their base cost. So when they go and sell the asset, they will pay the capital gains tax as well as their own. And so they've got to be in the UK in order to be an HMRC scope for that. The crucial point about this is that it's got to be an asset used in the trade of the transferor. So you've got to gift a trading asset, trading company shares, for example. And actually, one of the questions I got in advance was about this. Let me just see if I can bring it up. So we've got an example where a couple owns personal assets, so say $500,000 in cash, a principal private residence, and a limited company. If you gift the assets to the children, what considerations are taken into account? Well, with all of the assets, the inheritance tax. Straight away, if you've got a limited company and it's a trading company, you should get business property relief. But for the cash and the residence, that's going to be fully chargeable. So that's going to be a pet. So you've got to basically hope you survive for a further 7 years. The issue is going to be with the capital gains tax. Now, cash is exempt from capital gains tax. A principal private residence, by definition, is exempt from capital gains tax, but the limited company would not. But if it's a trading limited company, this is where the holdover would come in. So you should be able to claim holdover on those shares in that example. If you have agricultural land, or if you're a farmer, in-hand farmer, well, that's a trading asset. Farming is a trade. However, if you're a landlord and you've got a tenant on your land, you can still get holdover. I'm surprised this rule survived the budget, frankly, but if you are a landlord and you have this investment asset as agricultural land, it will still qualify for holdover if you gift it away. And you'll get it on the full value, not just the agricultural value, like under agricultural property relief. So if you're gifting company shares, again, like with BADR, got to be trading, so watch out for that sort of unofficial 80-20 trading split. It's got to be unquoted, AIM listed. It's got to be a personal company. So very similar to the BADR requirements. Just watch out with income tax. Just watch out for the employment-related securities element. That's something that might come out of that advanced question as well. If the person you are gifting those shares to is an employee or director, then unless you can show it's a close family, I can't remember the exact wording of the exemption, unless it's a family or social relationship, then there might be employment-related securities issues on that as well. So just double check that. If it is a gift at undervalue, so like I said in my example before, if you've got a business worth £1 million, you gift it away but you ask for 200,000. Well, for IHT purposes, you've gifted 800,000, but we've got a potential CGT issue here as well. What we've got to look is there any actual profit? So, for example, did they originally buy the business for 150,000? In which case there's a 50,000 actual profit. That will be fully chargeable. Only the rest of the gain is then going to be held over. So now technically that's not a gift. It's a gift of 800,000, but you have got something in return. But you can still get some gift holdover relief because there is an element of gift in there. Now just a couple of restrictions. If Section 260 relief, which I'll come on to in a moment, is available, you can't have 165. Section 260 takes precedence. I said as well that the recipient has to be UK resident and remain so for 6 years. Well, if they leave the country within 6 years, there is a clawback mechanism. So HMRC can go back to the donor and say, your recipient has scarpered, left the country, I want the tax back, please. Also, if you gift an asset into a what's called a settle or interested trust, so that is a trust whereby the person who sets it up, their spouse or their minor unmarried child, can benefit from it. There are income tax implications there. There are potentially gift with reservation issues for IHT, but for CGT purposes, you cannot get any holdover relief on that, not section 165 or 260. Also, when you look at the asset as well, any non-business periods of use. So again, a little bit like with the associated disposal, if you've owned the asset for 10 years, but it's only been used for 8, you can only hold over 8/10 of the gain. It doesn't need to be trading at the time of gift necessarily. You look at the whole period of ownership and you carve up the business and non-business use. Another one is non-business usage of buildings as well. So if you give a building, but it's say got a flat on it and a shop, the flat element needs to be taken out of it. Likewise, if you're gifting away limited company shares, if you've got non-business assets in there, that value needs to be stripped out as well. Now, 260, I'm just going to get down to my final bullet point here. This can be any asset whatsoever. The sole determinant for section 260 holdover relief is whether there has been an inheritance tax charge. Now, if you make a gift to an individual, remember, there is no inheritance tax charge. It's potentially exempt. As long as you survive 7 years, it's out of your estate anyway. The only time, really, when an asset will be subject to an immediate, what's called a chargeable lifetime transfer, is when it goes into trust. You can potentially make it when you gift it to a company, but 99 times out of 100, it's when you put something into a relevant property trust. So not a IPD trust, not an old-fashioned qualifying interest in possession trust before 2006, because they're transparent, remember? They're pets. No section 260 with pets. You only get this if there is an inheritance tax charge. Now, that inheritance tax charge could be 0, because the level of the asset could be below the nil rate band. It doesn't matter, you will still get your 260. Likewise, when the asset comes out of the trust, there is an exit charge. Again, hopefully at 0 due to the nil rate band, but it's still available. So when it comes to trusts, CGT is usually very good because you get 260 holdover relief. And that applies to any asset. So if you want to gift an investment asset that does not qualify for 165, you could potentially use a trust and you can get the holdover that way. Again, just notice this word trading under section 169S for BADR. They said pretty much exactly the same thing as section 165A says. Company trading on trading activities whose activities do not to any substantial extent include activities that are non-trading activities. It's our Sir Humphrey speech again, that it must be substantially trading. So just to hammer that point home, it not only applies to BADR, it applies to holdover as well, almost word for word. Surplus income. Can we gift away surplus income for inheritance tax? Well, and for CGT come to that. So you've got an income source and you don't need it. Remember, you've identified what is surplus and what you need. So this is surplus income. I don't need it. Well, if you don't do anything with it, it's just going to go into your bank account and rack up the value of your bank account. And then when you die, that'll be fully chargeable to IHT potentially. So the sound advice is give away that surplus income. There are no income tax implications. It's a gift. It's not employment income. There's no CGT implications because it's cash. And as long as it is surplus income, there's no IHT either, because IHT is a capital tax. As long as it is normal, and that means frequent or habitual expenditure out of income, it doesn't even touch the sides as far as IHT is concerned. It's not a pet. It's not your £3,000 annual exemption, anything like that. It doesn't move the needle whatsoever. Using trusts sound great, but do I recall they have to do a tax return and pay tax? Yes, if a trust produces income, they do have to pay tax. The trustees have to complete an income tax return, and if it's a discretionary trust, they have to pay additional rates of tax. However, if the beneficiaries receive some of that income, they can claim a lot of that tax back, because discretionary trust payments come with a refundable 45% tax credit. But yes, they do have trust obligations. If it's an interest in possession trust, it's usually just basic rate income tax. However, you can mandate income directly to the life tenant as well. But yes, you are quite right. The other thing with this surplus income as well is that it must not affect your standard of living. Because if it does, then that almost sounds by definition like you're gifting capital. The whole point is that you do not need this income, so it should not affect your standard of living. And HMRC could potentially find out. If the donor is frequently shopping at Waitrose and they start making gifts of income and they start having to shop at, at Aldi or something, well, maybe it's affecting their standard of living. So it's usually going to be a factual test. So generally, if you've got surplus income and it's not going to affect your standard of living, give it away. Just stop it racking up your bank account. Let it rack up someone else's who might actually need it. But the CGT is an issue. So we've got a gain inherent in most gifts. So if it's something like property, I mean, if you bought a property, frankly, I think more than 20 years ago, it's probably going to have a huge pregnant gain. But the question is, do I pay a 24% gain now, or do I pay 40% when I'm dead? Now, that sentence doesn't really make sense because, of course, you're dead, so you don't pay anything. And I've heard several clients say, I don't care, I'll be dead, so I don't want to pay 24% now because I've got to pay that at 31st of January. So there is sometimes an attitude that, look, I'll just pay the 40%, my estate can pay it because I don't want to have to put my hand in my pocket now whilst I'm alive. So if it's capital gain, the donor has to pay it. But if it's inheritance tax, it's essentially the beneficiaries that are paying because the money is going to be coming out of the estate. Just one thing that's often used. There is a slight sting in the tail here, but if we're looking at a residential property, one idea, which if feasible, and that's a very big if, you want to give away the value of the house, but you don't want to give away your house itself. Well, one option you can do is essentially take out a mortgage, take out a whopping great loan, so the equitable value of the house will be reduced. The next thing you've got, however, is a big pile of cash, so gift the cash away. Now, you've still got the same 7 years to worry about, but you keep the house, and for CGT, you don't have to worry about it. I mean, you wouldn't have to worry about it if it were your own house anyway under PPR, but if the PPR weren't available for whatever reason, cash is obviously exempt for CGT. There are a few practical issues there. You can just say get a loan, get a mortgage, as if that's the easiest thing to do in the world. It's obviously a lot harder than it was, and with interest rates being what they are, you obviously got to make sure that the mortgage can be serviced as well. Any future growth will stay in the donor's estate, obviously, from that point, but you still have the house. Oh, got a couple of questions coming up on this. Can you gift surplus income from your pension by drawing down more? Well, if you don't need it, then yeah, absolutely. I think you need to identify what your own income requirements are, because if you draw down that pension income, give it away and think, oh, actually, I could have done with that, then it could be a problem. But if you know for a fact that I do not need all that income in my pension, then absolutely, you can draw it down now. And indeed, I suspect that's what a lot of financial advisors might be saying because the inheritance tax changes in 27. Get it out now, spend it, and if you don't need it, yeah, give it away. So on the face of it, yes, I see no reason why not. But yeah, make sure it is surplus income is the point I'm making. Now, in that example just there, that cash has been gifted to an individual donee. Now, that's fine. What you used to be able to do before 2013 is take that cash and put it into a business. And as long as that business has been owned for more than 2 years, it gets instant coverage under BPR. It was brilliant deathbed planning. You didn't have to wait for 7 years. It was instantly covered. But unfortunately, HMRC saw that. The penny dropped in 2013. If you were to put that money into a business or a farm, APR, BPR, then what will happen is, in that example, the debt will not be secured against the house. The debt will follow the money and be secured against the farm or business, i.e. it will be completely wasted, and you'll have the full value of that house in your estate. So it no longer works. That example will only work if you essentially give it to an individual and not put it in what they call a relievable property. So something that qualifies for APR, BPR. So watch out for that. It used to work a treat, but it doesn't anymore. Okay, I want to make a gift. Whether I've borrowed it, whether I've taken out the loan against it, whatever. I want to make this gift. Do I put it into a trust? We've mentioned trust a couple of times now. Let's have a look at this. Let's do a bit of a comparison. If I give it to an individual, it's a pet. So there is no IHT to worry about as long as I survive for a further 7 years. However, if I put it into a trust, there is potentially some IHT to pay now or within 6 months. You need to look back 7 years and check what your nil rate band is. This is incidentally where that 14-year rule you might have heard about comes along. If there's a chargeable lifetime transfer followed by a pet, there's potentially 14 years to worry about. So there might be some tax to pay up front with a trust, but if it's below the nil rate band, there won't be. You've got some CGT when it goes to an individual, and because it's a pet, you cannot get 260 because there's no immediate IHT charge. You have to rely solely upon section 165, so it's got to be a trading asset. However, for a trust, you get your CGT. Now, when you die within the 7 years, the full value of the pet will be chargeable, hopefully with a bit of taper relief after 3 years, but the full value of the pet will come into charge. Now, with the trust, you've possibly already paid some at the time, so there might only be a supplementary charge that has to be paid. Again, hopefully with some taper relief in there. The other thing as well, putting tax aside for a second, and I think this is a very big issue that you need to bear in mind, once you make a gift to someone, it's theirs. You can't put, it can't come with strings attached, it becomes part of their estate. So if they go through a divorce, for example, that asset could be on the settlements table. And if that's the family silver or the family business, that could be an issue. If it's in trust, if it's in a relevant property trust, so a discretionary trust or a life or an interest in possession trust set up after 2006, it is not part of their estate. It's part of the trust. That trust has its own nil rate band. A relevant property trust is like another person. Now, the courts can smash trusts. The courts can smash companies as well if they think you are deliberately using the trust to get away from your obligations. But if you've got a long-standing trust that's in place, a divorce court would be very hard-pressed to break into it. So trusts can be very, very useful for keeping the family silver safe, not just deferring CGT. A couple of exemptions to bear in mind as well with IHT. So we're making a gift to an individual. There are a few sorry, it's slightly technical. Sorry, it seems to be sorted now. Don't know what happened there. Yeah, anyway, there are certain individuals and certain gifts that are exempt. Now, the most common one is a spouse. Whatever gift you make to a spouse, it's unlimited. For CGT purposes, it's no gain, no loss, provided they are still living together as spouses. But as long as you are still legally married, it's unlimited if the spouse is UK domicile, soon to be long-term resident, presumably. If the spouse is non-domicile or non-long-term resident, then only £325,000 is exempt. The rest is going to be a pet. But you can make, either in life or in death, you can make an election to treat that recipient spouse as UK resident. Well, that's great. That means you can give them or bequeath them as much as you like, but it means all their worldwide assets are going to be subject to UK IHT. Putting into a trust, chargeable lifetime transfer, would this avoid care home fees from the state? Again, possibly. If you are deliberately doing it to avoid care home fees, then the local authority can break the trust because they can say that it's a deliberate diminution of your estate. If, however, that trust was set up when the relative was good and healthy and there was no danger of going into a home, they would find it hard pressed. So it is possible to avoid it, but it's equally possible that the local authority could ignore it. Making a gift to a charity, as long as it's a UK-based charity, that's absolutely fine. That changed last year. Prior to April 2024, it just had to be a UK or an EU charity, but as we're not in the EU anymore, it's now just a UK charity. They can do work overseas, but they've got to be UK-based and subject to the High Court as well. Interestingly, this charitable exemption also includes political parties. A gift to a political party is normally not a qualifying income tax gift aid relief. But if the political party has 2 or more MPs in the House of Commons, or at least 1 MP with 150,000 votes at the last general election, they can qualify. So big party donors will get an IHT break. In lifetime as well, don't forget, there is a £3,000 exemption each year. So you can make a £3,000 gift each year, and again, it does not hit the radar at all. There's no pet. If it's under that, it doesn't move. When you are making a larger gift, let's say you make a gift of £200,000, don't forget, actually, it's 197 because you can deduct the £3,000. In fact, you could potentially deduct up to £6,000 a year because that annual exemption can be carried forward 1 year. There's also a couple of minor small gift reliefs as well. I'm surprised these have survived as long as they have as well. So you can make a gift of £250 per person to as many people as you like per year. But just coming back to that £3,000 exemption, just to want to hammer home this point about the carry forward. So let's say here you make a pet in 23-24 of 1,800. Well, I've still got a carry forward from my £3,000. I can carry forward 1,200 into the next year. So for 24-25, when I make another gift, call it a CLT, call it a pet, whatever, I can deduct the £3,000 from 24-25. I can also deduct the carry forward. Now I can't carry forward the full 1,200 obviously, because there's only 500 of gift left. But I can use 500 to bring it down to 0. Now the remainder of that, the £700 brought forward, is gone. The most you can have is a 2-year window that you can use it. So it's £6,000 within 2 years maximum. I've already mentioned a couple of these already, but gifts with no gratuitous intent, i.e. sale. That's not an IHT issue. You sell your business for £1 million, you get £1 million for it. That's not a gift by definition, so that doesn't come into the scope of IHT. Expenditure for family maintenance and, as we've already mentioned, normal, regular expenditure out of income does not come into play either. I've already mentioned the the spousal exemption. I say there's a little bit more detail in here about non-domiciled spouse, which I'll not go into, but the bit I just wanted to focus on this slide is this bullet point down here, unused nil rate band. So if you have, on first death, you have not used your nil rate band because you've bequeathed everything to your spouse, you can transfer that 325,000 to the surviving spouse. Likewise, you can also do the same with your residential nil rate band of 175,000. So potentially £500,000 can go to the surviving spouse in addition to their own £500,000. Now the thing to bear in mind is it's a percentage of the unused nil rate band at the time. We did have a different nil rate band before 2009. I've got an example on the next slide which I think will display that better. So if we imagine here that husband died, statistically it's usually the husband that goes first, died in 2002, and back in those heady days the nil rate band was only 250,000. Now he had used up 100,000 of it in his death estate. Maybe he bequeathed some to his kids, maybe he bequeathed some to other family members, whatever the reason. He'd used up 100,000. So on the face of it, he's got 150,000 unused. Now what does not happen is that you do not give 150,000 to the spouse who now dies in 2024. What happens is you give a percentage of the prevailing nil rate band to that surviving spouse. When husband died, he had 60% unused, so surviving spouse gets 60% of the prevailing nil rate band, i.e. 325,000. So she will get her own 325 plus 60% of 325, 195 to play with. Now the exact same thing happens with the residential nil rate band as well. This is known as a transferable nil rate band. So just watch that. It's not the unused nil rate band itself, it is the proportion of the prevailing nil rate band at second death. Okay, having a look at slightly meatier stuff now, and probably a little bit more relevant. APR, BPR. Now, at the moment, and for many, many years, certainly since 1992, there's been 100% APR, BPR, and it's been unlimited. So if you run a business, you run a farm, it's completely covered. However, we have this cap that's going to be brought in, mentioned at the October budget. There you go, I've mentioned 2030. Forgive that error in my last slide. The October budget increased the nil rate band. So 325, 175 for the nil rate band, and the £2 million taper for nil rate band has been frozen. But more significantly, that 100% relief for APR, BPR is being limited to the first £1 million. And that's a big deal. You know, a lot of businesses are going to be worth a lot more than that. A lot of farms Personally, I'm not convinced the government have got their numbers right here, because many farmers will have more than £1 million worth of kit in their sheds before we even get to the land. So the first £1 million of APR and BPR combined, it's not 1 million for each, APR, BPR combined will be 100%. Anything above that will get 50% relief. So it's not a complete cliff edge. So it's 20% tax after that. Now, the existing 50% bans have been completely unaffected. And more significantly, that £1 million allowance is not transferable from first spouse to the next, just like the nil rate band. It's one each. And once you're dead, it's gone. The surviving spouse can only have £1 million of allowance. Now, this is another reason why potentially a trust could be used, because a trust has its own £1 million allowance as well. Now, I noticed yesterday the government have launched a consultation on all this. So there is a slight chance all this may change. A trust may be given as many allowances as it has nil rate bands, because don't forget, if you have two people setting up one trust, there are two nil rate bands. You'd hope there'd be £2 million allowances as well on that rationale, but at the moment, one trust, £1 million allowance. So this is why people might be putting more things into trust as well. If you've got multiple trusts, like pilot trusts that used to be fashionable a while back, well, they each have £1 million as well, provided they were set up before 30th of October 2024. If you try doing that now, I'm afraid that £1 million is going to be shared by the settlor's number of trusts. AIM stock, alternative investment market stock, like EIS shares, they are currently 100% exempt, 100% relief under BPR. They're only going to qualify for 50% after 2026. I was actually surprised by that. I thought it would be removed from relief altogether, so not quite as bad as I thought. If you're making a lifetime gift, well, any gift that was made before 30th of October 2024, you're safe. It's the existing rules. So even if they die after someone dies after 2026 and it's a failed pet, you're okay. It's current rules. If, however, the gift is made after 30th of October 2024 and they die after April 2026, it's new rules. If the gift's been made after October 24, I'm afraid the only way you're going to keep the current rules is to die before April 26. And God forbid, I read on the news that one farmer has already done that to try and get out of this. So just having a quick look at what is APR, BPR. I mean, agricultural property relief, it is what it says on the tin, really. It's agricultural property, which is going to be land, pasture. It includes buildings as well, which can be very valuable. So ancillary buildings, also ancillary woodland, but also character appropriate farmhouses. So the house itself can qualify for APR. Usually only a percentage of it, hopefully a majority, because it's agricultural value only. So if you've got a plot of land that on open market might get £50,000 an acre, its agricultural value might only be 20,000 an acre. So APR will only cover that 20,000. It will only cover agricultural value. So you need to get a proper valuation generally. Agricultural property relief, 2 years occupation. If it's in-hand farming, as long as you have owned it and occupied it for 2 years, you will get the relief. If, however, remember, tenant farmers get holdover, or the landlords of tenant farmers get holdover relief, well, they also get APR as well. They do have to have owned the land for 7 years, however, if it's been tenanted, but they still get the APR. So the farmhouse, what makes a farmhouse as opposed to just a house? Well, it's a house that is occupied but lived in by the person who is farming the land. Basically, you need to have that common occupation. Person farming the land is the person living in the house. That's essentially what defines a farmhouse. It doesn't have to be in the same ownership. You could, for example, have a trust owning the land and the individual owning the house. That doesn't matter. Very often, who is the farmer? If you've got someone living in a house but someone else is farming the land, a tenant farmer, a grazier or contractor who's doing a little bit too much, well, if they are farming the land and not the person in the house, then it's no longer a farmhouse. The other thing that the legislation says is that it's got to be character appropriate, and that's all it says. So there's been quite a bit of guidance on this, actually, and there was a case a few years ago, a couple of cases called Antrobus, which gave a little bit more meat to these bones. Character appropriate means appropriate to its size, content, and layout. It's proportionate in size to the nature of the farming activities, and it also meets what they call the elephant test. Elephant test. Difficult to describe, but you know it when you see it. That's it. That's the elephant test. You look at a farmhouse and think, yeah, that's a farmhouse. Instead of using the man on the Clapham omnibus, your average Joe, you need to take someone who is a educated rural layman. So someone who knows a little bit about farming, a little bit about country life. Would they look at it and think, yeah, that's a farmhouse? Or would they just say, no, that's just a house with a big garden? Also, in historical dimension, has it always been a farmhouse? That will be taken into account. So look at all those things in the whole. Now, in the Antrobus case, the house Cookhill Priory, sorry for the slightly grainy picture, but you look at that and you'd think, blimey, that wouldn't look out of place in a National Trust catalogue. But it was a farmhouse. It was the person who lived in it also farmed the land. The question was it character appropriate? It looked a little bit more rustic and farm-like round the back, but actually it was held that, yes, it is occupied as a farmhouse, and that 70% of its value was agricultural. So the remaining 30% was chargeable. Now, business property relief is a little bit more universal. Now, with a farm, it's often both agricultural and business property relief. APR covers the agricultural value, BPR covers the rest. Now, for any non-farming business, you're just going to exclusively look at BPR. And say at the moment, the rates are quite generous. Any business, notice it's not trading property relief, it's business property relief. So the 80-20 split that we were looking at earlier doesn't apply here. But if it just must not be wholly or mainly one of making or holding investments. So it's a slightly different definition. So a business is a slightly wider definition than a trade. But generally, if you're talking about a trading business, whether it's sole trade, share of a partnership, 100% exempt. If you have unquoted securities, debentures for example, and you have a controlling stake in the business, that's 100%. And likewise, any number of unquoted shares. Even if you own 1%, if it's unquoted shares, you will get your 100% relief as well. But there is this 50% bracket. Like I said, that's not changing after 2026. So quoted controlling shares only get 50%. Off balance sheet assets, BADR again, associated disposal, I've mentioned already. If it's an individual or trust, with trust involved in a partnership or company, if it's off the balance sheet, you're only going to get 50% BPR. Same 2-year ownership requirement, no 7-year though. It's a straight 2-year requirement, and that's essentially what it is. Notice the difference, however, with BADR associated disposal. You own an asset personally, it's used by your company. It must just be a personal company. Here, however, to get the 50% at all, it's got to be a controlled company. So there's a slightly higher threshold with IHT here. Something to watch out for as well, we have to restrict business property relief if there are any what's called accepted assets. And those are assets which are not used in the business over the last 2 years. And are not going to be used in the future. This is what the person who asked earlier about the cash in the business, that might affect trade, it might hit 80-20, it might also be deemed an accepted asset as well if you've got too much of it. So generally, again, make sure it's working capital. If you've got a residential let, well, okay, a residential let might be tricky if you're in the business of making spades, but if it's lived in by an employee, that would probably be all right. As long as it's used in the business in some way, you're okay. But if it is not used in the business in any way, then it's got to be taken out. If you're in the business of making spades, having a rental property has got no place there. And again, surplus cash. Barclays Bank Trust Company case was a similar one about that. If you identify accepted assets, you just strip them out on a proportional basis. So if you identify that 10% of the company, say, is accepted assets, then you only get BPR on 90%. So it's a straight deduction in that way. A little bit like, as I mentioned before, with trading, you take the holistic approach. Just like you do with CGT, look at the turnover, look at the profits, look at the asset base, period of time, management time. Look at the business as a whole. Because for BPR, you are looking at the business as a whole. With APR, you tend to look at individual assets, the farmhouse, that scrap of land, that bit of land, that barn. But with BPR, you look at the entire business. And you may have heard a case known as the Balfour case, which looked at this. Now, the Balfour case, that's Prime Minister Balfour, his family. This is the Whittingham estate. It was a huge business, big land estate, and it had all sorts going on. It had in-hand, there we go, it had in-hand farming, it had let farming, it had let properties, it had water sports going on. Now, one argument could have been that it's two businesses. You've got letting on one hand, farming on the other, and that basically the letting bit doesn't count and the farming does. But if it's one business, HMRC's argument is that it's wholly or mainly one of making investments. So this is where the 50-50 comes from, and it's because of the wording of the legislation. Is it wholly or mainly investments or not? You don't need to say it doesn't need to be a trade, it just needs to be not wholly or mainly one of investments. So look at it in the round. Is it more trading than not? Well, when they had a look at this, when they had a look at the turnover, so look at the P&L, the turnover and the profitability, most of that pointed towards the trading element. So the trading side won. When they look at the amount of time spent by employees, most of that was on the trading side, so that won. Now the assets, slightly different story. When it came to acreage, it was about 50-50, so inconclusive there. However, when you look at the capital value of the assets, that was actually more in favour of investment, 1.88 to 1, so nearly 2 to 1 investments. So if you look at the balance sheet, it might tell a slightly different story, but when you look at it as a whole, as one unitary business, it was more trading than not. So the whole lot got BPR, even the let farms, because they were not accepted assets. They were used in one whole business. Not like my spade manufacturing business. That's got residential properties, got nothing to do with it. It's completely separate. So sometimes it can be a bit of a quandary. Is it a business which is one business that does all sorts of things or not? In this completely contrived and made up example, so I'll stop for a break and another break in a minute. In this completely contrived example, we've got a business, 60% of which is business, 30% investment, 10% cash. Well, if the CGT man were looking at this, straight away we've got a problem. The 80-20 split, you know, under 80% is under 80% is trading. So you're not going to get holdover, you're not going to get BADR on this at all. However, when you're looking at this holistically from an IHT perspective, it is more trading than not. So you should get BPR on the whole lot. The only question might be this 10% cash. Is that part of the business or not? We've had the question about cash already. Now, if it's completely surplus, not working capital, you need to take it out. If, however, you can say, nope, that cash is integral to the business, we're keeping it aside for future premises development, growth, whatever it may be, you should be able to get BPR on the whole lot. Let's quickly go through these potential issues. I'm just mindful of time. For those who are in farming, grass keep can often be a bit of an issue, because is that grazier on that land as a tenant or a licensee? If they're on there as a licensee, the landowner is still farming it because the license is nothing. If, however, they are tenanting the land, then they're not going to. The owner will not get BPR, and the owner will not be living in a farmhouse anymore. So just watch out with any grass keep. Make sure that it is a license and that the landowner has the exclusive right to occupy. Before we have a look at the Thomas Gill case, let's just stop for our 10-minute break. I know I certainly... Could we resume at 10 past again, please? Thanks very much. Notice some of you have put some questions in the Q&A. Forgive me, I hadn't spotted that during the break. I've answered some of them, and I will try and answer some more at the end, but I think some of them I might have to just get back to you on that. I'm not able to answer because there are quite a few, but I've got back to a few. Someone pointed out that I had an incorrect slide where I had the word not in. Offhand, I can't think which one you mean, so if you're able to let me know which one it is, I'll make that correction, and thank you very much indeed for spotting it. Sometimes it's wood through the trees sorts of things with these. So yeah, any feedback appreciated. So Thomas Gill is where we got to. This was just a grazing case. Now again, for those of you not in grazing, it's probably not going to be of much interest, but this is quite an interesting case to read because it gives a good idea of how HMRC approach APR and BPR claims. This is basically a chap who used to be an in-hand farmer, but he sold all his livestock and basically started looking after someone else's. And HMRC basically said that's an investment because you're basically like a landlord now. And so they denied that he was a farmer, and they denied that it was a business. So he lost APR on his farmhouse as well because he was no longer a farmer, he was a landlord. But all of that got overturned. And just for the character appropriate bit, there was a quote, I think it was by the brother giving evidence, said that the farmhouse was Spartan and basic, and that he looked like an old farmer, dressed like an old farmer, spoke like an old farmer, acted like an old farmer. He was an old farmer. So it's quite an interesting case to read. So again, just for time purposes, I'll let you have a look through that in your own time. But that's quite a good one to look at with grazing, if any of you have got clients involved in that. Slides are stuck again. There we go. Replacement property. This is just something with respect to APR and BPR for both. If you have a property that qualifies for APR, BPR, and you sell it, then obviously you're getting a big pile of cash. Now, as we've already said, that is not an IHT chargeable matter because you've sold it for $1 million, you've got $1 million. Okay, well, that's a CGT issue there potentially, but for IHT, nothing's happened. The only thing that has happened is that you did have an asset that was fully exempt from IHT, and now you've got a big pile of cash that is fully chargeable. So often the best advice is reinvest that into a similar APR, BPR qualifying asset. As long as you do that within 3 years, such that within a 5-year window, at least 2 is covered, then property 2 will carry on qualifying for APR, BPR straight away. Now, if they're both worth £1 million, that's fairly easy. But if property 1 was $1 million and property 2 is 800,000, say, you're obviously only going to get BPR on 800,000 going forward because the 200,000 has gone somewhere else, possibly to pay off a debt. Doesn't matter. So the advice generally is if you're going to sell it, reinvest it. Just for BPR purposes, APR, if you reinvest it within 3 years, you'll get your cover. It's 3 years for rollover relief. It's 3 years for EIS deferral relief. It's 3 years for this as well. So it does sort of make sense. I've mentioned already the interaction. Obviously, APR only applies with farms. So when you're talking about interaction, it's with farms. APR is agricultural value only. Business property relief covers the remaining non-agricultural value, often what's known as hope or development value as well. But just, yeah, a couple of warnings for those of you with farming clients. There is also a type of relief, and it's actually more of a deferral than a relief, known as woodlands relief. Now, if you've got a woodland that is commercial woodland, i.e. making firewood or producing wood for cricket bats or whatever, that should come under BPR. If it's ancillary woodland, it comes under APR. If, however, it is literally just a very nice bit of your garden that's made up of woods, you don't actually get any relief. What you can get, however, as long as it's based in the UK, is that you can get a deferral relief on the value of the timber. So when you die, the value of the timber is taken out of your estate until it is sold. It's not the land, it is the timber. So just that one might well be useful. I mentioned as well charities for IHT, just to go into a little bit more detail here. Get all of it up here. It does go a little bit further than that, in that it includes community amateur sports clubs that are in the UK, registered housing associations. If you make any gift for national purposes, this is often known as conditional exemption. So it's something that is a listed building or it's a prized heritage asset, for example. It can qualify. But these charities, however, must be, like I say, they've got to be UK based as well. Just going to have a quick word on trusts. I've mentioned trust a couple of times now, and I just thought it might just be worth going into a little bit more detail if you're not familiar with them. So we said about the advantages of the trust from an IHT perspective. It's another person if it's a relevant property trust. So there's another nil rate band, maybe even more, and there's going to be a potential £1 million allowance as well available. If you want to gift an investment asset, you can put it into trust for someone, and you can get Section 260 holdover relief. Now, if I were in person here, I'd be asking, who are these various people? Well, that's a picture of Thomas More, who was the Lord Chancellor during Henry VIII's day. Unfortunately, copped it in the neck. Sorry. Sorry, my screen keeps flickering. Why have I put the Lord Chancellor on there? Because the Lord Chancellor was what was known as the keeper of the King's conscience. This is where the law of equity came from. This is basically the law of trusts and beneficial ownership. For years and years and years, hundreds of years, it's always about whose name is above the door, whose name is on the deed. That's all that mattered for everything. But under equity, you look at, well, who's the real owner? Who actually, and this is where the definition of beneficial ownership and trust started to come around. It's often said around the days of the Crusades, although trusts have been around for a lot longer than that. But it was a principle of equity. And by the time we get to King Edward I and we get to Richard II, and say past the Crusades, we've got this concept of trusts and equity being a standalone law. And by this point, we had the Court of Chancery, which was always headed up by the Chancellor, and now we have a Chancery division within the High Court. So I've got just a little bit of history there about that. Again, I'm just mindful of time, I'm just going to move on. But a common example, it's a bit of a cliched example, the days of the Crusades when the knight would go off and he would leave everything to his squire. So B is the knight and A is the squire in this example. He'd say, here's my castle, look after it for me when I'm gone. Now, the squire is now the legal owner. So when the knight comes back many years later and says, thanks for holding that, I'll take it back now, the squire could say, no, it's mine, you gave it to me. And under law, the knight would have no recourse whatsoever. But under equity, under equitable law, quite clearly, the squire is holding that for the knight. He's holding it as a custodian, not as an owner. But only equitable law would recognise the knight's beneficial ownership. So the Chancellor would enforce A, said no A, no squire, it's not yours, you are holding it for the knight. And so we get these terms called uses. Around the time of Henry VIII they were abolished. A trust used to be called a use. The squire would be the fee of use and the B would be sesquique use, all dates from Norman French. And then by the time we get to the mid-1870s, the Judicature Acts, they actually said that equity will trump common law. And that's in the that's legislation today. Section 49 of the Senior Courts Act 1981, I believe. That says that equity will always triumph. And this is why beneficial ownership matters for HMRC today. So the concept of trust is born out of the rules of equity. A relevant property trust is a freestanding trust with its own IHT regime, essentially. So it has a nil rate band, it has exit charges when assets go out, it has a 10-year charge, every 10 years obviously, to assess its value. All discretionary trusts are relevant property trusts, they always have been. And an interest in possession trust set up after 22nd of March 2006 is also a relevant property trust. Any trust set up in life now comes under this regime. So if it's an old pre-2006 interest in possession trust, it's transparent, and that's known as a qualifying interest in possession. Disabled persons trust, as I've already mentioned, is not in the regime either, but you've got a charge every 10 years, and when an asset leaves, you've got the 10-year charge as well. But because you are assessing that against a nil rate band, and the trust has the benefit of APR, BPR, currently unlimited. Now you might come across a bare trust, or what's known as a nominee trust. Just a word of warning, as far as HMRC are concerned, these things don't exist. A classic example is a parent holding a bank account for a child. Children under 18 in England and Wales cannot open bank accounts, they cannot own property, so the parents or grandparents or whoever will hold it for them. That is a trust, that's called a bare trust because all the trustees are doing is holding it for them. They have no other powers. The beneficiary has a right to the income, to the capital, and once they hit 18, they've got a right to say to the trustee, it's mine now, give me the freehold, give me the legal title. But because the beneficiary has that much power, HMRC don't recognise them. They're transparent. So you tax the beneficiary direct, you tax the child as if it's their own. Children have personal allowances as well. So you can hopefully get a tax repayment if anything's deducted from them. Now, a discretionary trust, as the name implies, means that the trustees do have quite a lot of power. They have complete discretion over what happens with the income and the capital. Sorry, my other screen's flickering again. And the beneficiaries don't have to get anything. But they just have to consider the welfare of the beneficiaries and decide, are they going to get something? They can get a little bit of income each year, a little bit of capital. Now, the settlor is the person who creates this trust, because the trustees are the legal owners, the beneficiaries obviously the beneficial owners. The settlor is the person who creates it. Now, don't forget, a settlor can also be a trustee whilst they are alive. So a settlor can say, I am now holding this for someone else. If the trustee is someone else, they can give instructions to the trustee about what to do, and it's called a letter of wishes. Now, it's called a letter of wishes because you must not take away the trustee's discretion. Otherwise, by definition, it's not a discretionary trust. So like your pension is held in a trust. You give a letter of wishes to the trustees that says what happens if you die, for example. Now, in theory, they don't have to follow it. In reality, of course they will. But that's why it's called a letter of wishes. You generally, with discretionary trust, you have a class of beneficiaries. It's got to be an identifiable class, so it's usually my children and future issue. So the lineage will carry on down the line. Because a trust can last for 125 years, so it can span multiple generations. The trouble with discretionary trusts, however, is that they have a high income tax rate. It's additional rate. So 45% for other income, 39.35 for dividends. We had a question before about this. The trustees have got to pay that. They did have a basic rate of allowance of £1,000 until last year. But that sounds like a lot, and it is, and the trustees have got to pay it. But if the beneficiaries receive income, not capital, but any income they received, comes net of a refundable 45% tax credit, which they can claim back. And if they are children with a full personal allowance, not earning anything, and a full basic rate band, they'll be able to claim a majority of that back. Now, to keep track of what the trustees are paying and what the beneficiaries are reclaiming, this is why we have a tax pool. So the trustees have got to pay the tax for the beneficiaries to claim it back. If the trustees haven't paid enough, well, they'll have to top it up. The beneficiaries will never have any of their tax clawed back. But if they claim back tax that has not been paid by the trustees, well, the trustees will now have to pay it in the trust tax return. Interest in possession trust, which I've mentioned a couple of times, is a bit different. You've generally just got one person as the beneficiary, and they're often known as the life tenant, because for the rest of their life, they have the right to enjoy that property. And if that means that property is producing an income, they have a right to that income. The trustees cannot do anything about that. You can have various contingencies included in there, so once they hit 18, 25 or whatever. But when that life tenant dies, the trust will dissolve and it will go to what's called a remainderman. Usually a wider family member, but can be a charity. Ideally not the settlor again, it's usually someone else. They will get whatever's in the trust, absolutely. The trust has done its job. You can have more than one life tenant. You can have, you can have life tenants, joint life tenants at the same time, or you can have successive life tenants, so that one dies, another takes over. But generally, it's just for one person. A very common example is upon first death, you leave half of the house as tenants in common in an interest in possession trust to the survivor. That can often help with care home fees because only half of the house is owned by the survivor. And because the interest in possession trust in that case is set up in death, it's transparent. So it's an exempt transfer because it's a spouse. So that's quite a common example now. If there is any income being produced, it's all taxed at basic rates. So it's not quite as painful as a discretionary trust. You have an R185, which says what the income is. It says what tax has been paid. You give that R185 to the life tenant. If they're a higher or additional rate taxpayer, they'll have to pay the extra. If, however, they are basic rate taxpayer, they've got no more to pay. And if they're a non-taxpayer, they should get a little bit of a refund as well. Now, I've already mentioned qualifying interest in possessions before, so again, I'm just slightly mindful of time, because I wanted to finish just before midday, if possible, give you some of your afternoon back. But these are basically a qualifying interest in possession trust is an old style one. Say it's one that's set up before 22nd of March 2006. The only type of qualifying interest in possession trust you can have now is if it's set up in death, and that's what's known, like I've said already, as an immediate post-death interest trust. So it's usually set up as part of a will, and it can be set up as part of a deed of variation as well. The life tenant will get the interest in possession straight away. Not a TBM, that's a trust for a bereaved minor. So that's a trust that's set up by a parent who's died for a child. It mustn't be one of them. But basically what happens is that it's transparent with a qualifying interest in possession. The life tenant is deemed to own those estates themselves, so anything that goes in is a pet. Otherwise, it's a chargeable lifetime transfer to any other trust. Now, what are the advantages of a relevant property trust? There are tax advantages. Now, no aggregation. That means that if it's relevant property, it is separate from the beneficiary. I just said that now, that a qualifying interest in possession trust, the life tenant owns the asset, so they're all mixed in together. It's called their settled estate, as opposed to their free estate that they own personally, but it's all lumped in together. If it's in a relevant property trust, it's not aggregated, it's completely separate. So that's one tax reason for doing so. The trust has its own nil rate band, and it can use APR, BPR as well. So again, it's another person. A relevant property trust is another person essentially for IHT purposes. And it's got its own tax regime in the 10-year charge and the exit charge. But with trusts, what's also very handy are the non-tax benefits as well. If you want children to benefit straight away, children cannot own property. So they can be beneficiaries, however, of a trust, so they can still benefit from it. Generation skipping, it's often very handy for grandparents to give things directly to the grandchildren, because you've got, if parents give things to children, you've got settlements legislation, you've got income tax issues to worry about. So if it goes from a grandparent, you don't have to worry about any of that. So it's a good way for grandparents to gift assets, because when a grandparent is doing their IHT planning, they might think, I don't want to give it to my adult kids because they're in bad health, they're quite old themselves, they're going through a divorce, whatever it may be. However, we can skip a generation and give it to the grandkids and their kids and so on. Again, unstable relationships, if you want to give an asset to someone but they're going through a divorce, well, if you gift them that asset, it'll be subject to the divorce settlement. So if you put it into trust, hopefully, you can avoid that. Also, if an asset goes into trust, you can control. If you are the settlor, you can determine what happens to it, because you could be a trustee as well. Now, as a settlor, you cannot benefit from it yourself. Otherwise, it's settler interested, and they're generally not good. Your spouse, your minor unmarried children generally can't benefit from it. So you can't help yourself to it, it's gone. But you can still be a trustee and control what happens to it. Alternatively, you can give the trustees that letter of wishes where you can say what happens to it. So you're gifting it away, but you've still got some control. It's gift with strings. There are a few sort of practical issues to consider. Are you letting the tax wag? I like that phrase, is the tax tail wagging the dog here. You're so desperate to save IHT, which is fine, but a trust can be quite a burden to have. You've got that discretionary charge, the discretionary trust, paying the additional rate charge. So if the money's going to accumulate and the income's not going out to the beneficiaries, they cannot claim that tax credit. So that's 45% tax each year. They've got your fees, solicitor fees for setting it up. There's a trust tax return. There's a trust registration service. Are those tax benefits actually worth it? And that's the other second bullet point here. Can they afford it as well? Will the trust give the beneficiaries enough income? If 45% tax is being deducted each time, is there going to be enough there afterwards? Also, will the family be happy with a trust? I mean, trusts have, I think, unfairly got a bad reputation. They can be abused like any other vehicles. But the asset's going to be locked away. The settler can't benefit, so it's gone. Are they going to be happy with that? Do they trust the trustees? The clue is in the name. You trust them. Now, if you're, as a settlor, you're the trustee, you've got some control, but what happens when you die? You've got to have some other trustee to take care of it. Who will be the trustees if you don't have much family? You can have professional trustees, solicitors, lawyers, accountants as well, but they're expensive. And again, a trust only lasts 125 years, so maybe a limited company would be better. Limited companies last forever, and if you're just accumulating money within a limited company, there's no personal tax to worry about. Also, when you're putting together a deed of trust, if you're putting land into a trust, it's got to be done by deed. Any deed, it's a legal document, it's a reserved legal activity, so only barristers and solicitors can do this. So if you're setting up a trust of land, you've got to get a lawyer to do it. If you are not a lawyer, it's actually a criminal offence. If you charge for it, you can actually get 2 years porridge. So solicitors have got to be involved with drafting up deeds because they are a reserved legal activity. I suspect that'll change before long. I mean, accountants can now do non-contentious probate and be commissioner of oaths. I suspect paperwork activities like this will be available to accountants before long, but just for now, that's where we are. Now, when you're looking at property, you want to gift property. You've got CGT to worry about as one thing, and it's harder to carve up. So property can be very useful for trusts because obviously they last a very long time, they produce good income, they can be lived in. So when you're looking at trusts and property going in, there are some advantages here. For a start, generally there's no stamp duty land tax because it's a gift. Now, if the trust is going to assume an existing mortgage, there will be SDLT because that is consideration, like with any gift. If you're assuming a debt, that is deemed to be consideration. But if you've got no mortgage on the property, and that's a generally good candidate for a trust anyway, if there's no debt to be paid, then there's no SDLT. We've already mentioned as well, there is no CGT either due to section 260 holdover relief because it's a trust, because there's a chargeable lifetime transfer, and there you go. Even though you can only have 4 legal owners of property, you can have as many beneficiaries as you like. So as long as they are defined, you have a class of discretionary trustees, that's absolutely fine. So you can cater for multiple generations and even multiple wishes. So one beneficiary might want an income stream, some might want some capital. So it's an awful lot more flexible than actually carving up the land itself. However, a few things to think about. You've got the 10-year charge as part of relevant property regime. That means every 10 years, the value of the trust will be assessed. Any value above the nil rate band will be taxed at a maximum of 6%. Now that's a maximum. It can be lower. It's quite an excruciating calculation. It's usually somewhere around 4. It depends how much nil rate band is available. So every 10 years there is a charge. Now property tends to grow in value, certainly over 10 years. So that's something to watch out. Say cash generally doesn't itself, unless it's charging interest, but then that's income. Now, if rent is coming off the property, that is going to accumulate within the trust. And if it builds up and builds up and builds up, it's not paid out after 5 years, it becomes capital. So that'll hit you with your 10-year charge, the value of the property plus the value of the accumulated income as well. So generally, trusts are only of any use when you are paying that money out. It stops the money, it stops the cash accumulating, and also it means the beneficiaries can reclaim some of the tax back. That money's just accumulating in there. The trustees are paying 45% each year. If you want to accumulate money, maybe look at a limited company instead. Before 2008, there was a thing called an accumulation and maintenance trust where you could do that, but those are gone now. Okay, just this last bit that we wanted to have a look at. This is a lot of the cases surrounding this are generally regarding farms. Because proprietary estoppel is when somebody is given a proprietary stake in land, despite it going somewhere else. The classic example is farming again. Dad saying to son usually, one day son, all this land will be yours. Just stay with me on the farm, work your fingers to the bone for no pay for years, and I'll give it to you. Son think, great, I'll rely on that promise. I'll do exactly what the old man says. And then dad dies and he leaves it to the cat's home or to his siblings or someone else. Now, legally, Dad can do that. We have testamentary freedom in this country, so he can do what he likes. But clearly that's not just. Again, we're coming under rules of equity now, because estoppel is from the Norman French word stop. It means you can't do that. Even though legally it's fine, under rules of equity it's not, and equity prevails. In the case of Crab and Arran District Council, Lord Denning, who was a big proponent of this proprietary estoppel, gave a quick description of what it is. It seeks to prevent a person from insisting on his strict legal rights, whether arising under contract, title deeds or statute, when it would be inequitable for him to do so, having regard to the dealings that have taken place between the parties. So if we're looking at a family business and succession, if we're giving the sort of vibes to younger members of the family that you're going to get this one day, but you actually give it to someone else, equity could potentially intervene. Now, the ingredients of proprietary estoppel, I'll come back to constructive trust at the top there in a second. The ingredients generally are as follows. A promise is made or some sort of assurance. Now, the problem is that's usually verbal, and the person who's usually made it at this point is dead, because this only really comes around after someone's died. It's contentious probate, so accountants generally can't deal with it. But what we're talking about here is where the beneficial ownership goes. Now, legally, Dad may have given this to his siblings, but what he's saying is, hang on, I deserve a beneficial stake in that property because of the promise that Dad made, but he's got to be able to prove it. He's also got to prove that he relied upon it. Now, if he was going to stick around on the farm anyway, then you have not got sufficient causation between the promise and staying on the farm. You've also got to show that he has acted to his detriment, and that can be quite wide. It doesn't necessarily have to be paid money out. It can be foregoing an opportunity of some sort as well, and there's generally got to be an element of encouragement involved. Now, what a constructive trust does is that will impose trusteeship on the person who got the legal property. So in this example, trusteeship will be imposed upon the brothers, and the person who is wronged will be a beneficiary of that trust. So a constructive trust is like a tool of restitution. It puts right that went wrong. It will give the legal owner, it will say, yep, you're the legal owner, but you're holding this on trust for your brother, for your sister, whoever. So it's imposed by the courts, not by the parties, when there has been either a criminal or an equitable wrong. Now, just a few cases here, just to sort of show you some of the examples that we've had on this. Thorner and Majors is quite an old one now, but it went to the House of Lords, and again, this was a farming one. So the claimant here, this was David Thorner, who worked on his cousin's farm 29 years without pay. That's that would probably be deemed as slave labour now. But the reason he did so is because his cousin handed him documents for 2 life insurance policies and said, here you go, this covers my death duties, i.e. inheritance tax. Now, in this case, he thought, oh, that means it must be me paying the tax, so I'm going to be a residuary beneficiary. And indeed, he was. The residuary estate was left in the cousin's will, but they fell out. And so the will was torn up, and so cousin died intestate. So David Thorner said, now, hang on a minute. The farm is, it's being held intestate, so it goes to his wider family members. I should have it because he promised me the farm based on these insurance policies. Now, the High Court said, well, okay, yep, you're absolutely right. The personal representatives, the administrators, you are holding this on trust for David. Quite right. He was given a promise, he relied on it, and he's now lost out. However, the Court of Appeal said, no, that's ridiculous. Why would you think that just being given an insurance policy gives you the right to a farm? Why would you work for 29 years without pay on such a flimsy basis, essentially? It's not what they said, that's my own words. However, the House of Lords came back and said, no, the High Court was right. Even though objectively speaking, a couple of insurance policies doesn't seem like good grounds to think you're going to get the entire farm, but that's what David thought. He thought that, and he relied upon it to his detriment. Therefore, the final sentence of the judgment there, if David did then rely upon that to his detriment, the necessary element of estoppel is established. So it's really a subjective case. What did the individual think? Did they think they were going to benefit from this? Did they intend that as a serious assurance? If they did and they relied upon it, that's it. Now, a case that's fairly near to me, where I am in Somerset, this is actually daughter. Daughter was told, stay with me and the dairy unit will be yours. There's 1 son and 3 daughters. Lucy was the youngest, and Lucy had basically built up the dairy unit, and she'd worked in the family for years. But they'd fallen out, and she left the farm, and they actually sold the farm eventually. And when Lucy sort of came back into the fold, everything had been left to her siblings. And she said, hang on a minute, I was promised the dairy unit, I'd built it up. But Dad had died, and so Mum turned around and said, well, your dad didn't say that. So straight away we've got an issue of sort of denying that he ever said it. So he said, look, it's not binding on me, and the farm's mine now. I'm his executor. And anyway, apparently Lucy had exaggerated the work she'd done. You'd not worked that hard, you hadn't done that much anyway. So, however, the farm had been sold, so we couldn't have a constructive trust here because the farm had already gone, so that wouldn't have worked. The great thing about the equitable courts is that they can do whatever they like to right a wrong. They can impose a constructive trust on a property, They could have given Lucy a license to occupy or a charge over the property, but the property had gone. All that was left is cash. So the court said, well, in this case, Lucy is entitled to 45% of that cash. So siblings, pay your sister £1.17 million so she can go away and buy herself her precious dairy unit. That was deemed to be the best remedy in that particular case. So the equitable courts can do what they like to right any wrong. The Court of Appeal upheld that back in May 2019. So Haberfield and Haberfield is quite an interesting case. I find it interesting anyway. Guest in Guest was another farm, also in the West Country, well in Gloucester as well. As usual, there'd been a falling out in the family. One brother had left, another brother remained, and then when the partnership was dissolved, one brother was left out of the will. Now, this went to the Supreme Court, and again, I'm not going to go into this in huge amounts of detail. It's 11:45, and it's quite a complex read, but this was really saying what type of remedy is in place here. They said, well, brother who was wronged, yes, he was wronged, there's a proprietary estoppel issue here, but what should he get? If he gets the money now, he's actually gaining, because he wouldn't have got this until after Dad had died, and at this point Dad was still alive. So if he's getting money now, then he's actually better off, so surely he should get it at a discount. The question as well for the Supreme Court is, what exactly is the value of the detriment? Should it simply be what's called the minimum equity to do justice? Or should it be held that it's actually going to be, the compensation is to fulfill the expectation that brother had, rather than compensating the detriment? Now, the courts basically said, look, you can have the money now, if you like, but it's going to be, because you're getting it now, you're actually getting a bonus, so we're going to take a little bit of it away. Or it can be held in trust, so that when Dad dies, you can get it then. But the point of that is compensation to fulfill the expectation rather than the actual detriment. Because in this case, the brother that dipped out wouldn't have got a detriment because Dad was still alive. If he got his money now, he'd actually be better off. So this is a very complex case, and so that one went to the Supreme Court, and again, another farming case. But the reason I'm talking about this to you now with regard to OMB is that when you're handing the business down, if you're giving the expectation that son, daughter, whoever's going to get it, then they might actually make a proprietary estoppel claim if you then give it to someone else. So really what you need to be doing to clients is getting something in writing. If you want the kids to have it now, you can do lifetime gifting. If they're going to have it when they're dead, have that conversation now. Get something in writing to say that the kids will get this after we're gone. Because if you give the impression that they'll get it and they rely upon it, but then you give it to someone else, to a cousin or something, the proprietary estoppel claim could mean that it actually goes to the kids. And with these cases going to the Supreme Court, it can be incredibly expensive. I just wanted to finish off really about wills. A will, actually, it's not a regulated document, whereas trust deeds are. Wills are not. Anyone can have a go at doing a will. You can write it on the back of an envelope. There are very, very few regulations that we'll come on to in a split second, but it's just a legal declaration saying what's going to happen to my property once I'm gone. And nowadays it generally says what's going to happen to my body. I want to be cremated, I want to be buried. But that's essentially what it is. Generally, if you're not doing wills, then you should still be advising clients go and see their solicitor regularly to get it reviewed. Because you might have left it to someone and that person might be dead, you might have fallen out with them. The formalities from a very old act, the Wills Act 1837, it's got to be in writing. The only type of verbal will that's available is called a privileged will, and that's only available for members of the armed forces. So it's got to be in writing. It's got to be witnessed by two people who are not beneficiaries. And when they mean witnessed, they mean literally watching you sign it. You can't be in the room or come in later and countersign it. You've literally got to watch them sign it. And you've got to be over 18 as well. But that's it. There are no other regulations in there. There's no regulations saying that it even needs to be dated. And this can be a problem when there is multiple wills, because like the old detective novels and the Rumpole of the Bailey, which will came first? You should date it, but it's not actually a requirement. Some of the other requirements are that you've got to be of sound mind, as well as being 18. You've got to be of sound mind, and that's often how a will is challenged. Said whoever, you know, when Dad wrote his will, he was not of sound mind. But otherwise, you can do what you like. It's not like in, I think, France, Italy, maybe they have what's called forced heirship, where you have to leave a certain amount for the kids. You don't have to in this country. Now, if it's jointly owned property, so not tenants in common, if it's jointly owned, when you die, the survivor gets it automatically. It's not subject to the will. The co-owner will automatically get it. So a jointly owned house, for example, when one dies, the other automatically receives it because they both own 100%. If you want to bequeath your half of a property, you've got to put it into tenants in common, and then you own 50% each. You can do with your 50% what you like after that. Now, the reason why wills fail, so if we're looking at a business here, and actually this is one point just to mention, a will is only has effect over personally owned assets. If an asset is a partnership asset or a company asset, then it's judged by the partnership agreement or the shareholders agreement. The will only determines what happens to your shares or your share of the partnership, but assets within the company and within the partnership are subject to the partnership agreement. So that's another good reason to ascertain, is my asset a partnership agreement or not? If it's not, it's subject to the will. If it is a partnership asset, then it's subject to the partnership agreement. So that's another reason to get it down. But reason why a will fail, those formalities are not addressed. It's not in writing, it's not witnessed. Someone signed it under duress. They have to be of sound mind and sign it under their own accord. So if they believe someone's been strong-armed into paying it, that is going to be an issue. Lack of capacity. Like I said, if you believe that the person who signed it was not of sound mind, that's another way to strike it down. But also, if there is a new will, because the first thing most wills say is, I hereby revoke all existing wills or testaments, or something along that line. If the will has been destroyed, and it's got to be destroyed such that you can't read it. When you get married, if you're a bachelor, when you get married, your bachelor will is revoked. Likewise, when you get divorced, the will is not struck down, but the spouse is deemed to have died. And if you've left everything to the spouse, it's effectively going to be useless. Any alterations as well. Alterations have got to be done properly. It's got to be done through a codicil or something like that. You can't just scribble on it. And then intestacy. Intestacy means either you do not have a will or your will is invalid or the gift has failed. Now, the rules of intestacy are very strict. They're a real pain. They take forever. If you've ever tried to buy a house from an estate that's in intestacy, it's got to go through the courts. But there is a strict pecking order. If it's just you and your spouse, when the spouse number one dies, and if they've got no will, provided the surviving spouse survives for 28 days, they will get it. If you have a spouse and children, well, the spouse will get all the chattels, that's all the tangible, movable objects. They will also get a statutory legacy, a fixed amount of up to £322,000, and they will get half of what's left. The other half of what's left is held in trust for the children. If you have spouse and near family, the spouse will get everything. If you have children only, the children will get everything equally, but if they're under 18, obviously, it's going to be in trust, and this is what's known as a bereaved minor, a trust for a bereaved minor. So there's no 10-year charges or exit charges until they're 18, so that's a form of accumulation trust for children. Now, if you don't have a spouse, you don't have a children, then there is a strict sort of flow chart from this. You then look at your siblings of whole blood, and then very Harry Potter-esque, we've got siblings of half-blood, so your half-brothers and sisters. If you don't have any siblings, it can go up to the grandparents, which might not be great if they're doing some IHT planning of their own. The last thing they want is to be given a load more assets. If you don't have any siblings or grandparents, we then go diagonal. We then go to uncles and aunts. First of all, of whole blood and their descendants, so their children. If you don't have any of those, it will go to aunts and uncles of half blood and their descendants. And if, bless you, you've got no one in the world, it'll end up going to the Crown. Or where I am in the southwest, probably to the Prince of Wales instead. So that is intestacy. It is a real pain, and the only way you can avoid it is to get a will. So just to summarise, with the business, not only a will to show the personal assets, you need to get a partnership or shareholders agreement in place to determine what are partnership assets and company assets, what are personally owned assets as well. If you're going to be bequeathing the business further down, get everything in writing, have the conversation. Don't let it all take place after someone's dead and relying on promises and relying on detriment. Get everything down in writing, get partnership agreements, get wills, get powers of attorney as well, and get everything in writing and discussed, and that'll make things so much easier. I'm going to finish off there, so there's just my disclaimer saying don't rely on a word I've said. The Q&As that have come through, I will try to answer as many of those as I can. Oh, thank you, Alan, for the not. I will take that out. I'll try and get to as many questions as I can, but I think I'm going to have to send most of them by email, so I'm going to have to rely on Richard to help me out there, because there's quite a lot of questions in there. Just very quickly, what about nieces and nephews? That's descendants of your uncles and aunts. Just seeing if there's any I can answer straight off. Would husband and wife need a will, or they automatically get everything when the partner dies? They would automatically get everything when the partner dies, but that's through intestacy, and then you need a will for yourself. So get wills, just get mirror wills. So when the first one dies, the respondent will get everything, but get it under a will, not through intestacy, because that can take months, even years. Can requirements of signing a will still apply for DocuSign? Ooh, during COVID, there were some rules about DocuSign. I think you still require physical proximity. I think during COVID, you could sign it over Zoom, but I think they've gone back to being in person. But I might be wrong, so I think ask the solicitor about that. But sorry, I'm going to have to get to these other questions another time. Thank you very much for them. Thank you very much for your attention over nearly 3 hours. I know that can be quite painful, so it's very much appreciated. So thank you very much indeed, everyone, and enjoy the rest of your day and enjoy your weekend.